the first time this year, the market is starting to get nervous about the potential or higher probability of some sort of harder landing.
All equity markets are at a risk simply because you are at the point where the unemployment rate in the US is very low, is starting to pick up.
It's clear to me that we're going to see slower growth over 2024 relative to 2023.
It was only a couple months ago where the narrative was re-acceleration even, but I think the data now have more clearly slowed.
The market is expecting this slower growth and inflation outlook. That doesn't mean that you're going to have a hard landing.
This is Bloomberg Surveillance with Jonathan Perro, Lisa Abramowitz, and Anne-Marie Hordern.
It is a new trading week, and it is the start of the end of the first half. Good morning. Welcome back. Anne-Marie Hordern, Danny Berger, Lisa Abramowitz, Sean Farrow still off until next week. We are looking at the end of the first half that is ending with a bang. It is a three-part act. The first part is whether or not you could get some kind of broadening out of this market action, which we got a hint of at the end of last week. We get economic data, including the key core PCE data. And then, of course, it really heats up on the political front on both sides of the Atlantic. I want to start with markets, Danny. This idea of we saw the Russell 2000 outperforming in a significant way for the first time in a very long time as big tech lagged.
It's this, can the catch-up trade happen? A lot of folks thought it would happen to start the year. It still hasn't. The issue this time around, Peter Scher lays this out really well, that you had this happening last time, that the data was improving and the rest of the market wasn't catching up. Now the data is not improving, but it's okay. Can we really play the catch-up trade in that environment?
And when you say the data is improving, sort of, or it's not that much improving, but it's okay, it raises the question of what's going to be okay, Anne-Marie, this week. We get core PCE, we get personal income, personal spending at a time where there's sort of this odd dance. Will people tolerate high prices? And is that a good thing or a bad thing?
Well, this is what is going to be so important on Thursday's debate, because Trump is going to come out and try to talk about how the economy, things, cost of goods, more expensive now than they were under his term. Paul Donovan this morning. Lisa, I thought of you the second I opened up his note. Quote, politics, sadly, is in focus. He talks about inflation, and he said it's one real-world issue that has political resonance, and he says inflation is an emotional issue, not a rational issue, which is why it's been so hard for the Biden campaign to explain that the rate of inflation is coming down. But that's just here in the United States. You brought up on the other side of the Atlantic, the first part of this legislative election kicks off in France on Sunday. And the economy, once again, the polls are showing that actually Macron is due for a bruising.
Okay, pause. A lot to unpack there. Danny, I want to just tell you that to Anne-Marie's point, I did look at this week and I thought, this week is all politics.
Yeah.
And as much as I don't want that to be the case, it is all politics, whether it's the debate that really kicks off the season. Earliest debate in modern history,
yep.
Right? Between two presidential candidates. But Danny, then we get the French election that's caused spreads to just gap out between French bond yields and German bond yields.
See, this is the thing. I'm totally with you, Lisa. I usually would have looked at this week and said, the politics doesn't matter for markets. It's amusing is the wrong word, but it's the only word I got, and who cares? But you look at what's happened around the world, Mexico, India, France, Germany, it matters. It matters for markets, and it matters to an increasing amount. I mean, will the debates matter? Will we get anything about the deficit? Maybe if we do, that will move markets, but it's having an impact.
When you say the deficit, this is a reason why I care particularly about the bond auctions this week. I just want to say, I know everyone's saying...
Front page of the FT this weekend, the weekend edition, front page is the concern about the fiscal risk. And looking into 2025, this is going to be a huge debate, because whether or not we get Trump or Biden, the deficit's going to go up.
Just to put that into perspective, $69 billion of two-year auctions tomorrow. You get $70 billion of five-year treasuries on Wednesday and $44 billion of seven-year treasuries. Just to state a state of play heading into the beginning of a new trading week. Last week, we got this sort of eking out of gains, but they really were led by the Russell 2000, up about 0.8% versus the simply flat performance on the NASDAQ. Today, you can see a bit of what basically ongoing flatness, lack of any kind of action, marginally up on the S&P. NASDAQ down just a touch. What you can see in Treasury yields just lower just a touch as we game out whether or not the economic data can continue to support that. That's on the 2-year. 10-year yields up higher, just marginally for 26%. In the euro, 107.22, just strengthening a touch after weakening to end Friday, basically below 107. As for the week ahead, today we'll get Fed speak from Mary Daly. Tomorrow, more Fed speak, plus the Conference Board's consumer confidence data and FedEx earnings. Wednesday, new home sales and earnings from Micron. Thursday is headlined by, as we were talking about, the presidential debate. We'll also get jobless claims, durable goods, and earnings from Nike. And Friday, More Fed speak, plus personal income and spending and the core PCE deflator. That, to me, is going to be really key, Danny, given the fact that people are talking about the potential for maybe things to come online with almost the Fed's expectations at 2.6%, getting closer to that.
I think the worrying piece in there, as we learned last week, is going to be housing. I mean, housing is still a pretty major component in core PCE. And we saw that housing starts weren't there. The supply isn't coming back online. It's still a sticky part. It's not coming down. And it is such a big source of personal inflation. So if you're in the scenario where the housing component is usually not coming back online, it's not playing ball, how can the Fed really be bullish about cutting this year?
All right, coming up, we've got Lori Calvasina of RBC with stocks coming off 2 days of losses. Terry Haines of Pangea Policy as Trump's VP search comes into focus, and Citigroup's Robert Sockin calling for a September rate cut. We begin with our top story, kicking off the final week of the first half with stocks coming off 2 days of losses. Lori Calvasina of RBC writing this: the continued outperformance of mega cap growth stocks has been logical, but still somewhat jarring to us. Small caps broke to clear new lows relative to large caps last week, and investor sentiment continues to concern us. Lori, thank you so much for being with us. You're joining us now. And really, I want to start with this idea that we're starting to see a broadening out. We're starting to see the small caps just begin to eke out some outperformance. Could this be the beginning of something bigger?
Well, thanks for having me on, as always, Lisa. Look, I would love to sit here and tell you I hope that that's the case. I think that small caps will have their day in the sun, and we certainly keep having these really good days in small cap relative to the rest of the market that keeps sucking us in. But if you pull up a chart on your Bloomberg and you look at the Russell 2000 relative to the S&P 500, just a relative ratio, we keep breaking to new lows. And even with some of the improvement that we've seen on certain days recently, you really haven't been able to abate that trend. So what's driving that? I do think that sentiment is already pretty washed out on the small cap space. If you look at CFTC data, you're back around regional banking crisis lows, the SVB lows, essentially. But if you look at other indicators, you really have to, first of all, attack what do you think is going to happen with the Fed? RBC is calling for a December cut. We still see other shops calling for something earlier. I really do think you need to get the cut figured out because essentially small caps don't tend to pre-trade cuts. They tend to outperform after the cuts happen. So any disappointment we get on that cut narrative is just going to push these stocks right back down. The other thing that you really need for small caps to work is an above average economy. And one of the things you guys were highlighting in the opening with all those clips is some nervousness that's starting to come back in, some squishiness that's starting to return on the consumer. And we're not really seeing a big reacceleration or a big upward revision to GDP forecast for this year or next the way we were at different times over the past 6 months. So those economic tailwinds that helped the rotation get started at certain points over the last 6-9 months, we're just not getting that right now. So I'm staying more neutral on this space. I like the positioning. I don't like the situation with the Fed, and I don't like the fact that the economic story seems like it's slowing a little bit right now.
So neutral on this space, but for much of this year, people were basically underweighting small caps and saying, keep going into big tech because it's a freight train and you can't get in front of it. Has that changed?
So, it's interesting. We've been talking about mega cap growth the last few weeks in our weekly, and I had one investor write me in and say, it just feels like these stocks are tired. Like it just feels like they're sort of on their last leg. And I was thinking about that at the end of last week when we started to see some rotation out. I think the problem that you have in this big cap growth part of the market and these kind of Mag 7, or Mag 1 type stocks, whatever bucket you want to take, is that growth rates are slowing from astronomical levels to things that are still pretty strong, but clearly a notch below what they've been. And what I've noticed just in the past couple decades that I've been doing this job is that whenever that happens, you just don't have as much of a margin for error. People get angsty. People are looking for reasons, looking for excuses to take some money off the table. And, I know there were technical things that contributed to the weakness late last week, but I do feel like that's something that is going on here. And that adds, if you kind of broaden out, yes, you could technically maybe get some rotation where the rest of the market doesn't do as badly. But I do think that contributes to kind of my nervousness on the stock market, just the sheer weight of these areas. And if they're starting to hit some air pockets, they're starting to hit some potholes and people are kind of looking for an opportunity to take money off the table, that can have ramifications in the broader market.
Just on the sentiment for tech itself, Lori, we talked about on Friday the Marco Hartnett note from Bank of America that said that there were record inflows into tech. That's kind of being questioned whether it was just an ETF with some technical flows having to do with rebalancing. So given all that, can you just categorize the sentiment around tech and the positioning in tech? How stretched at the moment or not stretched does it look?
So I believe he's looking at the EPFR data on the flows. I'm not positive about that, but we do watch that data as well. We put it out in our weekly so you can sort of see the technology sector inflows. We look at a 4-week average because that data tends to be very, kind of lumpy and volatile week to week. And we have seen some big inflows going back to the tech space and the large cap growth space. But I tell you, Danny, if you look at the chart, it's like kind of parabolic. And it's one of those charts as a strategist, I look at it, it's gotten kind of close to past highs, and it looks like it's ripe for reversion. So I do wonder if we're going to get some confirmation that we were starting to see some outflows when we get the data updates over the next couple weeks. If you want to sort of put that flow data aside and kind of think about general sentiment, I would urge you to look at the CFTC data, which unfortunately I don't think came out on Friday because of the holiday last week. But they do have some data on NASDAQ 100. I think it's E-minis or minis, but it's a futures contract looking at that NASDAQ 100 part of the market. And you can get that weekly. If you look at that on a net notional dollar value basis, where we have been over the last, at different points in time, say over the last 6 months, is at levels that were a bit above the 2013, 2015 highs. And so if you go back over the whole life of the data series, we've seen that sentiment, so to speak, on the mega cap growth trade part of the market, very, very stretched and more stretched than what we've seen over time. It has come down. It has not collapsed. We sort of look at it as like maybe the fevers come down from like 103 to 101. So it could obviously, kind of spike back up pretty quickly, and it's not back down to normal. But I think that's a good, sort of barometer for what I'm sensing in client meetings. Yes, some of the momentum has come off. Has it completely collapsed? No.
Just in terms of diversification, Lori, part of the reason that perhaps so many people went into this is you look at other asset classes. You look at bonds that are still negative. I mean, barely at this point, but still negative for the year. Base metals up only 3%. So you'd understand why people would go into this trade. But Lori, once that turn does happen and the conversations you're having with clients, are they prepared for it, or has diversification been thrown out the window for the sake of gains?
Well, I think it depends. It's a great question, Danny. I think it depends on which kind of investor you're talking about. Now, I spend most of my time talking to portfolio managers who run equity funds, and they're benchmarked to indexes like the S&P 500 or like the Russell 1000 growth. Some small cap managers in there as well, and value managers, obviously. But one of the problems that a lot of these managers have had is that even though they own a lot of these particular stocks, they can't be overweight because of structural reasons. So the kind of high-flying nature of these stocks makes it very, very difficult for them to outperform their benchmarks. If you look at actually sort of some quality factors in the market, and we talked about this in our weekly today as well, you're starting to see within the Russell 1000 as well as the 2000, most of the quality factors we look at are starting to work pretty well. That augurs well for active manager performance. So I think it's, not necessarily just a question of, do people like these stocks? Are they doing well? Are they going down? What does that do to absolute returns? Always ask about the long only PM. Are they outperforming their benchmarks? And I think if you actually take some of the heat out of some of those names, it can make their jobs a little bit easier.
Lori, we have the election in full swing this week with the kickoff of the first presidential debate. You told us early on this year that you continuously get asked about the 2024 presidential debate, but it's like looking into the sun. Have you gotten any clarity on potentially how to position ahead of this, or what you're now telling clients?
So I would say if you think you have to really divide it between the non-U.S. investors and the U.S. investors. If we look at the U.S.-based people, right, people who are sitting in the U.S., understand our elections, system the best and the issues at best, I continue to find that people just don't like talking about this issue. It's something that they've increasingly had to because they're getting more and more questions. If I think about some of my hedge fund conversations over the last month or two, I can definitely count a number of people who have told me that they're not making trades on this event, that they've done it in the past, but they're not doing it now. When I think more about long-only investors who are less inclined to sort of make those short-term trades, they're really struggling to understand the salient differences from a stock market or economic perspective between the two candidates. So you'll often sort of see people look at both agendas and say, well, these guys are both inflationary. So are we just looking at a higher inflation world over the next few years regardless? I think there's a lot of focus on the tax policy. That's where there do seem to be some salient differences that are really starting to come into focus. I had one investor put it to me recently and just sort of said, look, there's not a lot to do, but is this going to end up being something that sort of paralyzes the investment community for a period of time? And that is a thought that I think makes a lot of sense. I think there's a bit of fog here when you think about the 2025 outlook that the election is creating, even though there's not a sense that people really know exactly what to do right now with either outcome.
Lori Calvasina of RBC Capital Markets, thank you so much, as always, for being with us. Right now, let's get to an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Haques. Yahaira.
Hi, Lisa. Marine Le Pen's far-right national rally is making further gains ahead of the first round of France's snap election. According to Bloomberg polls, tracking polls, the party has increased its lead to 34.2%. This means President Emmanuel Macron faces the increasing likelihood of having to share power with an opposition government. The first round of voting takes place on June 30th, and the second round will be on July 7th. Apple has been hit with the formal warning from European Union antitrust enforcers for allegedly stifling competition on its App Store. The European Commission says the iPhone maker must allow app developers to steer users to cheaper deals and offers outside of the App Store. The new order comes under the bloc's Digital Markets Act, which lays out a raft of do's and don'ts for some of the world's largest technology platforms. And Boeing may be facing criminal charges. U.S. prosecutors are recommending the DOJ charge the plane maker for violating a settlement related to 2 fatal crashes. That's according to Reuters. The report, which cited people familiar with the matter, did not specify what charges the Justice Department is considering. The DOJ found in May that Boeing had breached the 2021 deferred prosecution agreement that was put in place after the 2 737 MAX crashes killed 346 people in 2018 and 2019. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, Trump's running mate coming into focus.
There's a lot of interest, tremendous interest in the debate. And, when you say prep, I think this is prepping.
Have you decided who your vice president is?
In my mind, yeah.
Do they know?
No, nobody knows.
That's coming up next. This is Bloomberg. Heading into a week of, yes, that's right, politics, very much front and center as markets remain kind of range-bound, trying to find direction after kind of crawling to a weekly gain last week. We're still crawling upward, 55.38, just up about 0.1%. The euro just marginally stronger. Nothing going on in the bond space. And crude up about 0.5%. Under surveillance this morning, let's get straight to the politics. Trump's running mate coming into focus.
We have a lot of people coming. There's a lot of interest, tremendous interest in the debate. And, when you say prep, I think this is prepping. These people know better than anybody what they want.
Have you decided who your vice president is?
In my mind, yeah.
Do they know?
No, nobody knows.
Here's latest. Former President Donald Trump saying his VP candidate will be in attendance in Thursday's presidential debate. Trump hitting the campaign trail in Pennsylvania while President Biden hunkers down to do debate prep at Camp David. Terry Haines of Pangea Policy writing this. Only if Trump picks Nikki Haley for vice president does Trump have the best chance at victory. And the race materially changes if that happens. Our instinct is it's by no means impossible, but it isn't likely. Terry joins us now. Terry, before we even get to the vice presidential sweepstakes, there's a question of just this debate and what you're looking for in Thursday.
Well, fundamentally, what has to happen in the debate is I think that Biden has to exceed expectations. The expectations are very high for him the bar is a little higher for him to come in, and do what I call the frame, show that he's up to the job and show that he's the kind of kinder, gentler, centrist, safer pair of hands, as the English would say, compared to Trump. Trump, of course, has to not only disrupt but also embody the narrative of dissatisfaction with the economy, dissatisfaction with the border, and convincingly promise that he's able to make it better. So, to me, those are the basic basic touch gloves moments. But the stakes here, I think, are very high, not only politically, which is obvious, but I think also for markets. You all talked about, sadly, it's politics, but politics and U.S. political stability, is an underpinning of the market that's been taken for granted so long that most investors don't even think about it. That's starting to be tested now, not just in the United States, but the UK, France, and beyond.
Terry, what do you make of the fact that The president is hunkered down in Camp David, and he's preparing with his team. It feels like for days, taking it very seriously. Not saying the former president isn't taking it seriously, but he's out and about on the campaign trail, basically calling that prep. Is that going to work?
I think there's an awful lot of theater that's going on with Trump as ever. Saying he's prepping. Well, he's prepping, all right. He said also he wanted to take this very seriously. He's a little lighter on his feet than Biden is at this point. But of course, Biden's got more to defend. It's easier to be on the attack. So there's that, and of course, he's throwing red meat to the press all the time, whether it be this supposed vice presidential choice or anything else. So I tend to think there's a lot more going on behind the scenes here with Trump than he's letting on. Trump
also said that his VP choice will be in attendance at the debate, but no one knows who it is. Who are you zeroing in on?
Oh, well, I don't want to step on your lead, which was of my lead, which was, I think if he picks Haley, there's a material change in the race. That depends on the debate performance, of course. But that's a Republican unity ticket, and Trump very much needs that right now because the Republican Party remains split and independents aren't exactly flocking to him. That's the formula he needs in order to win. Beyond that, there are a variety of candidates. You kind of got unity light with somebody like Governor Youngkin of Virginia, and you've also got the attack dog idea, and that could be somebody like Senator Scott of South Carolina. It could be somebody like Senator Cotton of Arkansas. A lot of different choices. Where I'd put my money today is I very much doubt Trump's made his choice because he's not to the point yet where he knows with clarity exactly what he needs to do before the convention to unify the party and move forward.
You mentioned Governor Youngkin being unity light. Trump is going to Virginia the day after the debate. Is this a real potential? Does he think, one, he can really win Virginia, and two, Youngkin could be on this ticket?
Well, Virginia's a lot more in play than most people think. Back in 2016, I think it was, Virginia was one of a few states that came in under 5%. You've got a classic problem in Virginia, same as Illinois, New York, where you've got a blue core, in this case, Northern Virginia, and you've got the red, the rest of the state, and how those balance off determines who wins. Trump is very interested in pumping up red turnout in Virginia and also splitting blue turnout in Northern Virginia. He's got a shot at that. I think ultimately he's not successful at that, but the opportunity to put a state in play forces Biden to play defense, and so that's positive for Trump.
So just taking a step back, Terry, because this is a debate that is much earlier than it typically is in a presidential cycle. What does that mean for how consequential it will be?
Oh, I think it's very consequential because it sets a tone for the campaign. It's the first time that a great mass of the American public, much less a great international audience, has really focused on the American election in kind of a laser-like fashion. So it's important in that sense, and it is a tone setter. I don't think it's dispositive, though. The error that markets may see, that a lot of political people may see, is, oh, this happened, that happened, whatever happened in the debate, that's going to determine the state of the race going forward. It's really not. And I cited in my note to clients yesterday examples going back to 2008, where the first debate wasn't particularly dispositive, and also, of course, this allows both parties, should there be an issue or a problem, to have the maximum amount of time for clean up on aisle 7, political version.
Terry Haines of Pangea Policy, thank you. Clean up on aisle 7 for the next 6 months. Is that what we're looking for?
Well, they're giving themselves a lot of time, the entire summer, basically, to clean up if Thursday does not go well for either candidate.
What are you watching, Danny, on these debates?
I'm so fascinated that they get their mics cut when they're not speaking. I want to hear if anyone tries to yell over it. Is that wrong? That's what I'm watching.
No, I hear that. Exactly how that's going to work in terms of cutting people as well prematurely. Coming up, KBW CEO Tom Michaud ahead of the bank stress test results this week, heading into the end of the first half. The The start of the last week of the first half of 2024. Welcome back. Good morning. We're looking right now at a market that's trying to eke out maybe another record high, but really just crawling upward after last week, really losing steam. What we saw was the S&P outperforming the NASDAQ. This was a departure from what we had seen in the past, and we see that continue this morning. And we see the Russell 2000 continuing to outperform. To me, this is really the big takeaway, Danny, of what we saw over the past week. It's basically the Russell 2000 finally rearing its head with the biggest outperformance in many months as people look beyond just big tech.
But the question, of course, is can it last? Can it last if the data is just okay? Can it last if it's only one cut we're going to be having this year? With so much of the Russell 2000 exposed to higher debt loads, how aggressive of a rate cutting cycle do they need to have before it's actually attractive again?
And you went straight to rates, so let's go there. 2s, 10s, and 30s as people look forward to the idea of potential rate cuts. But is it for the right reason or the wrong reason? And that's the reason why small caps have been buffeted to such a degree. Last week, we saw a cooling in the economic data, ongoing disappointments. However, Friday's S&P global PMIs came out stronger than expected. So it sort of was this equilibrium that left people in a better place, at least for the small cap world. 2-year, 10-year, and 30-year yield basically going nowhere ahead of a slew of auctions. And I got to say, Emery, you were actually interested in the auctions this weekend, which I thought was fantastic. Welcome. But it really does seem like that's going to be very much in focus as a referendum on some of the political noise that we keep hearing about.
Well, the auctions are more interesting also because we have fresh CBO scores talking about the fact that the U.S. actually is spending more. And many are just pointing to the fact that this fiscal trajectory the U.S. is on is unsustainable. And then you start thinking about 2025. Wall Street Journal editorial today talking about what Senator Warner told us. Tax Armageddon. What's going on potentially next year. There's going to be a lot of debates about the trajectory of not just tax spending. We have the debt ceiling showdown in January, and all of this is going to put in focus how much the U.S. spends.
At the same time, the U.S. has been the least worst offender at some point, which is the reason why you had seen dollar strength this morning. A bit of a reversal. We are seeing some yen strength versus the dollar for the first time in a long time after there were warnings from the United States not to intervene. And then overnight, Danny, we saw some discussion in the Bank of Japan meeting minutes saying they discussed potentially hiking rates further in order to strengthen the yen.
It's remarkable that the market either, one, doesn't believe them or it's yen vigilantes coming to challenge the MOF, because even though they might say that their last meeting, they didn't lay out their bond buying program, winding that down. So many folks said, okay, we're not going to get a hike next meeting because then you're going to have to lay out the program in that meeting. So what you get is yen weakness in this interesting little bout of strength right after intervention warning from the MOF.
Which raises a lot of questions, which we will get into in rumor form, not at all on the show. However, if we get solid reporting, we'll bring it to you. Under surveillance this morning, Israeli Prime Minister Benjamin Netanyahu telling local TV that the country will end the intense siege in Gaza soon, saying the next step will be redeploying forces to northern Israel, where its conflict with Hezbollah has spiked. Anne-Marie, how much are we underplaying the story of the conflict between Israel and the northern border with Hezbollah in Lebanon?
Well, Netanyahu telling this Israeli broadcaster that's going to be now the new focus. What I was struck by more or less what Netanyahu said, what we heard from the chairman of the Joint Chiefs yesterday. He was talking about the fact that if this were to happen, Iran would get more involved in support of Hezbollah. And the question now, everyone is wondering if this were to happen, and we will have more than just skirmishes, but really more of a conflict between Lebanese Hezbollah and Israel, will that trigger a broadening of this war?
That's exactly it, Anne-Marie. It's the threat of escalation. That's why markets were first worried when this happened, when it first broke out. Not even that. I mean, you look at last week, the leader of Hezbollah was threatening Cyprus, basically saying you're allowing the Israelis to come use military bases to fly out of there to attack Hezbollah. I mean, now we're having threats against EU nations. It's, again, exactly the kind of escalation threat that markets are concerned about.
Talking about escalation, another forum on the economic front, Europe and China agreeing to talks over the EU's decision to impose tariffs on some electric vehicles. Earlier this month, the EU announced plans to impose tariffs as high as 48% on EVs imported from China, fueling trade tensions with the country. But Anne-Marie, it's not the 100% tariffs that you're seeing from the United States.
No, it's not. They still want to maintain that access to the European markets, which is why potentially they're saying, let's have legitimate discussions about this. Potentially they can lower some of those tariffs, and maybe in lieu of that, the European Union will still be able to import some of these luxury goods into China. We did have Vladis Dombrovskis have a call with his counterpart, and they said it was candid and constructive, both sides agreeing to engage in the basic facts and in full respect of WTO rules. I think a lot of people in the United States would say that China has not been playing by those rules.
Well, and that is an ongoing potential tension between the U.S. and Europe, depending on how much their manufacturers depend on Chinese sales. Meanwhile, all eyes on the presidential debate and the Fed's preferred inflation gauge. That's due out later this week. We'll also get the results of the Fed's annual bank stress tests on Wednesday. They come, as the Fed said, J.P. Morgan, Bank of America, Goldman, and Citi all must approve their blueprints for a hypothetical wind down after the central bank found weaknesses in their plans. Joining us now, I'm so pleased to say, is Tom Michaud, CEO of KBW, a Stifel company. Tom, a lot of people have been raising this issue about whether we're fighting the wrong war and whether maybe some of what the regulators are targeting with banks is counterproductive for the current cycle. Do you think that that's going to be in focus later this week?
Well, I think, first of all, with the stress test, the first thing you're going to see is that the banks are in very, very good shape. Remember, the stress tests were set up to look at an adverse scenario to show the marketplace that they have plenty of capital to withstand that. And we think that the conversation is going to move away from that to individual company analysis quickly, which is actually a really positive statement about how the industry has been continuing to build capital. The other thing is the industry's not only been building capital for the stress test, but the industry's been building capital to get ready for Basel III endgame. So that's been the big story. So I think the first box to check is that the industry is going to come out as being very well capitalized. And then there are going to be individual companies that are pivoting in one direction or another.
So there's a lot to unpack. There's a question about which banks, let's start here, are really strong and resilient, right? I mean, it's one thing to say JP Morgan and Bank of America and Citigroup aren't going to fail. I don't think anyone is saying that they're at risk of any kind of real potential turmoil. It's really the regionals. At what point do we get some confidence there?
So there are 23 banks in this test that's coming on Wednesday. So they start to go down into the super regional category. I think for all 23 banks, the market's going to say they have plenty of capital. I think for the regional banks are still in pretty good shape, except for the ones where there might be more concern around real estate exposure, for example, and you're seeing a downturn in some of their results. But by and large, and again, I think it's very narrow as to where the concern is. I just, in preparation for coming today, I was interested about dividends. I went back and looked at there are 74 banks that are in the Keefe Bank Index or Regional Bank Index. If you look at since the beginning of last year, 5 of them cut or eliminated their dividend. Meanwhile, 54 of them raised their dividends over that period. The industry is actually in really, I think, pretty good shape for the challenges that we've had. And I think that the areas of concern are generally more narrow than you would think. And then remember, last year's bank failure moment was really around a liquidity crisis. And what we realized is that some banks had gotten offsides in terms of their concentrations and their deposits. I don't think that was a broad-based trend.
Even so, I mean, every now and again you hear of another bank that maybe isn't hedged to interest rates. The latest one was a large bank out of Japan, I think their largest agricultural bank, who was basically positioned for rates coming lower. Obviously, that hasn't happened yet. When you hear these incidents of pockets of stress, do you think that these are still the rare bank that haven't hedged against the current rate environment? Or if it's higher for longer, do we hear more of this?
So I think with the focus for this conversation right now being in the U.S., I'll go to our Bank America upgrade, which we did recently. We have earnings models by quarter for net interest income. I think just about all of the 220 banks we follow, nearly all, are going to hit a bottom on a quarterly basis, either last quarter or this quarter. That's the reason why we upgraded Bank America, is the second quarter is the inflection point, and it gets better from here. So it's all a question of timing. There's another point. The 3-month, 5-year yield curve spread is the most important for banks. I know that plenty of attention's on 210s. That's not the key for the banks. It's been 62 years since we've seen the length of time for the inversion that we've had. So all things really kind of need to do is get a little bit less bad for these banks to do a little bit better. And I think that pivot is right here, right now. And these banks have a lot of bad news in them. As long as we don't get a hard landing, I think you're going to see a continuing quarterly improvement over the next 4 or 5 quarters. And also too, there are specific types of banks we like more than others. But this is a great opportunity if you can look longer term, we think.
I know you want to stay in the U.S., but I have to take you to Europe, especially given we're going to get one of the first rounds of French voting on the 30th. You've had the likes of J.P. Morgan really be courted by Macron, saying, come move to Paris in a post-Brexit world. And you've seen other U.S. banks do something similar, really building up operations and talent bases in Paris. If there is political volatility, what happens?
So I think it's really the big picture of what's happening with the economy. One thing I would note is over the last 12 months, banks have been the leading group in Europe. Again, there was so much bad news in these stocks. And really what you need in Europe is you needed some improvement in the rates. Negative interest rates were certainly adversely affecting the banks. Our sense is it all comes down to what the economy is doing. We still think there's upside for the banks because the banks have done a lot to stabilize themselves over the last several years. And many of those stocks still trade at 60% of book value. So we think that the bigger banks are stable in Europe. And it's a question now of what's happening in the economy.
Does it concern we heard last week from the Fed in terms of living wills of some of the U.S. biggest banks finding some shortcomings when it comes to the likes of Bank of America, Citi?
You know, you remember that teacher in college who was always a hard grader who never really gave out the, oh, this is perfect, you're all done, you don't have to do anymore? I will imagine for the rest of my career, every year there will be more work to do on a living will, okay? And if you look at the living wills, J.P. Morgan had work to do. Citigroup had work to do. And really, these living wills are evolving with the risks of the moment. And also, I would say, given last year's bank failures, the FDIC has probably sharpened their pencil on these living wills. But so I would view it as it's a living, breathing thing. I didn't see it. Our view on it is the banks are going to spend more money at preparing for them, but that there was nothing devastating or really significant in what we read in the results.
I have to say, the reason why I started by asking you, are we looking at the wrong risks, is because in the past couple of years, first of all, the risks that I hear about, what profitability opportunities do some of these smaller banks have when they're facing off with the rush of money into private capital? That's a big question at this point. Oh,
there are some tectonic plates that are moving that if you want to take a step back and not look at the snapshot and look at the movie, yes. And really what it comes down to is funding and liquidity and deposits. Banks don't fail because of capital. Banks fail because there's a bank run. And there have been very few of them in the United States. So the capital's fine, but really what's happening in the deposit base? I think the greatest missed opportunity from last year is there's not been FDIC deposit insurance reform because it puts too much pressure on the small banks and it's encouraging market share to move up cap to the banks that have proven that they're too big to fail.
And it also, yeah.
So that's the biggest. And then number two is when it comes to stock selection, the way that regional banks, smaller community banks earn money in the biggest banks is very different. The smaller banks have more real estate and more spread income. They're going to be slower to rebound. The bigger banks Bank of America, amongst the biggest banks, has some of the least amount of commercial real estate exposure. These bigger banks have already made the shift away from that. And that's why we are leaning in heavier on these bigger banks for the stock ideas. We think it's going to take a little bit more time for the regional banks to turn.
There might be safety and even profitability in some of the bigger banks. There isn't so much of the classic market making, and this is the other risk that people talk about. Liquidity risk on another level, that they're not going to be able to shepherd this amount of bond auctions into the market and allow the trading to commence with the same kind of stability that it has in the past. Does that keep you up at night?
Now you're talking about the Treasury market?
Yeah, in the Treasury in particular, given the fact that the market has swollen to such a huge part, but it's also the credit market. I hear about this with public credit as well.
Well, what I take out of that is passive investing is at the highest degree of our lifetime and growing more. And in many ways, it's changing the investment business. So there are so many of these indices and index-driven funds that so much of that, and it's impacted the liquidity of a lot of the smaller companies. So if you look at a typical mid-cap stock, it may have 35-40% of their shares owned by passive investors, and it's happening in the credit markets as well. So when you get to individual credits, so that's pushing more of the trading into private markets away from some of the public markets. And so I think that is going to have an impact. So the way in which companies raise capital is all still evolving because there's this big private market that's grown a lot in the last 4 or 5 years.
Tom Michaud, awesome to hear from you. Thank you so much for being with us.
Yes, thank you.
Tom Michaud of KBW. Meanwhile, what we're looking at right now in markets is a bit of stability despite all of that. Up next, we're going to be talking about the Fed. September very much on the table.
We've had 2 great CPI numbers. It's not enough for the Fed to move, obviously, in July, nor do we think that they should, but we definitely think September's on the table.
That's next. This is Bloomberg. Coming into a new trading week with a tiny bit of gains as we try to build on what we got last week. Again, just sort of limping to the finish with finishing up with 2 days of losses on the S&P, on the NASDAQ. Right now, gaining on the morning, up about 0.1%. The euro strengthening just a touch, yields just a touch higher, calm before a potential storm. Under surveillance this morning, September on the table.
We've had 2 great CPI numbers. There's things that are looking positive in terms of, as we've talked about, jobs coming down, which should lead to lower wages going forward. It's not enough for the Fed to move, obviously, in July, nor do we think that they should, but we definitely think September's on the table.
Here is the latest. A key week of economic data on tap. We'll get consumer confidence tomorrow, then another round of jobless claims on Thursday, and the real big one is on Friday with the Fed's preferred inflation gauge, the core PCE deflator, in addition to personal income and spending. Robert Sockin of Citigroup writing this. Our base case sees the Fed cutting rates in September. We expect a recession later this year, which leads to continuous easing from the Fed after this move. Robert joins us now. Robert, we saw last week a real shift in terms of the perception of the economic data, a question of whether the weakening was real just weakness. You think it will turn into just weakness. How do you gain confidence at a time where other people see, for example, the S&P global PMIs and the U.S. PMIs on Friday pointing to just a considerable amount of strength?
Yeah, absolutely. And I think this is a really challenging period for the data because depending on what you're looking for, you can find a story in a different set of data. So if I wanted to talk about resilience, as you said, I would note the PMIs, which surprised to the upside. And GDP for the second quarter still tracking pretty strongly. If you look at the Atlanta Fed's nowcast, for example, something near 3%. But there's definitely softness brewing in a lot of other areas. In particular spots that we're concerned about is if you look at the housing sector, we've had very weak housing data. Multifamily housing starts are running at some of the lowest levels of the last decade. And jobless claims have consistently come in above expectations or stayed elevated for the last month or so. So we definitely think we're seeing cracks. Now, that being said, we've seen cracks in this cycle before that haven't materialized into a sharper downturn. And the broader economy has remained very resilient. So, a sharper downturn by no means is guaranteed, but I think the risks of that are higher than they were, let's say, a few months ago.
And one of the, cracks or maybe weakness, depending on how bad you think it is the consumer. But your forecast is that the spending starts to shift from services towards goods. What gives you the confidence of that, especially when so much of the language right now is just all-out price fatigue?
Yeah, absolutely. And it's been a really challenging forecast because we've been looking for this broader rotation into goods for a while, and you've just seen this very long tailwind of spending into services after the pandemic. It's been much broader and lasted a lot longer than we've expected. What makes us think that it's still likely to happen is, one, we think, again, a lot of that is built on this post-pandemic appetite for services that's likely to continue to fade. And two, we think those goods that were purchased earlier in the cycle during the pandemic, they're likely to wear out. And people are going to want to buy new goods like new cell phones, new computers, then incorporate new technology like the advances in AI. So we're still looking for that rotation. That should take some of the heat out of labor markets and inflation because good sectors are less labor intensive than services. And a lot of where we're seeing inflation now is still in services sectors. So I think that rotation, if it's done right, could be a very positive thing. But we have been expecting that for a while and still waiting for more of that rotation to come.
Do you need that rotation to maintain your call for September rate cut, or potentially these cracks you're seeing in the labor market might be enough?
I think you can still get to a September rate cut, even if you don't get the sharper downturn that our U.S. team has in its forecast. We're expecting just 0.15% for core PCE on Friday. Very important print this week. And I think if you continue to get market progress on inflation, even if the economy holds up well, the Fed probably by September is likely to conclude they've made enough progress to start easing rates. So even if the economy is resilient, I still think September is very much on the table. But that case that we talked about earlier of a continued easing after September, there I think you really need that sharper downturn. Otherwise, the Fed's going to start easing, but be very patient.
I want to ask you about the politics because you're global. You're looking, I'm sure, at both sides of the Atlantic. Yeah. It's a big week. Lori Calvasina talked about this paralysis, basically, in investments and in markets because of the U.S. election. Do you see politics impacting economic data right now? Can impact where consumers' sentiment may be going?
I think you see a lot of politics influencing market movements, especially as we've seen in France in recent weeks. And I do think on a sentiment level, you usually see politics influencing those numbers a lot because there's always a large politics element to things like consumer confidence measures, business confidence. However, I don't think anything we've seen to date is really enough to move the economic needle in terms of the data right now. I do think a lot of the results we've seen, like what's going to eventually happen in France, what we've seen in India, what we're going to see, of course, in the U.S. later this year, is going to influence economic policy a lot in the years to come. I think topics like migration are very much on the docket in all of these elections. In this cycle, for example, we've seen very large gains in migration, which is likely one of the reasons that the U.S. economy has been resilient. I think that's going to be a heated issue that's going to be debated in this election. So I very much look at politics as very important, but probably guiding the outlook over the next few years rather than shaping the economic data now.
I like that you talk about sentiment and this idea of what's affecting it. And a lot of people say, just ignore it and look at what they're doing. And what they're doing in the U.S. is spending and spending and spending some more because it's sort of the hedonism of the American consumer that you pointed out in a recent report has really lifted the U.S. to become one of the few outperformers relative to the pre-pandemic trend in the past couple of years. How important is spending on Friday? How important is it for it to continue in order to maybe suggest that this has another bout of strength before we really do weaken?
Absolutely. And in that report, as you know, we said the U.S. consumers sort of stood in a league of its own. If you look at major developed markets, Australia and the U.S. have been the two biggest performers in terms of growth. And that's really been a consumer story. And the U.S. consumer is a league above all of those other major developed economies. And that's why we continue to see resilience. And as you noted, you've seen very soft consumer confidence measures throughout this cycle in many periods, but the consumers continue to spend. So I think it's very important. A lot of that spending has been on services. So when I see the sort of retail sales numbers, which have been a bit softer recently, I'm looking to the services side and saying, are they continuing to spend on services? But I think that is the backbone of this cycle. If the U.S. consumer starts to pull back, and we've seen some strains in lower income consumers, so you could get a larger pullback there, that would really be, I think, the signal the cycle would be turning. But right now, every quarter, the U.S. consumers just continue to spend.
Robert Sockin of Citigroup, thank you so much for being with us. And there was this great statistics from Sri Kumar Global Strategies talking about how when you take commodities without food and energy, the prices actually fell by 1.7% during the 12 months ended May. Services, other than energy services, Danny, rose by 5.3%, more than twice the Fed's target.
I'm really fascinated by this idea that Robert was talking about, though, that if we are seeing some weakness, it's simply a consumer who's about to shift, that is about to shift from all the services that they started to hoover up once they came out of the pandemic and going towards goods. So it's, can this spending continue, but it just takes a different form.
Well, if you look at the data on Friday and the statement we got from S&P, led by service sector, that's reflecting this demand still. Everyone's still waiting for this potential rotation. And I feel like it's not going to happen this summer when you see an absolute resurgence of air travel and ticket prices to reflect that.
To Europe.
Yeah, well, this actually is something that we do need to keep talking about is who is traveling, who is spending on services.
Bifurcated consumer.
How bifurcated it is and how long that could continue before there's some real problems that develop. Coming up next, Seema Shah of Principal Asset Management, Isaac Boltanksy of BTIG, BlackRock's Amanda Lynam, and Bloomberg's George Ferguson. This is Bloomberg.
Markets are definitely moving somewhat towards this risk-off hedging bets against equity potential weakness.
Markets are a bit priced to perfection. It would be quite healthy if we can get some kind of consolidation over the next 3 months.
This is a time where we like to get consolidation. We have to sort of try and protect what we have.
Seasonally, it's lower volatility, but I don't think we've gotten to the point where people are capitulating.
You have to trade this market. You have to take a week to week.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Can Goldilocks continue into the second half of this year? Good morning. Welcome back. This is Bloomberg Surveillance from our New York City studios. Anne-Marie Hordern, Danny Berger, Lisa Abramowitz, John Ferro off. He will be back later this week. The reason why I really ask that question, can Goldilocks continue, is because there are signs underneath the market that there is a shift going on where suddenly big tech kind of hit a pause, Danny, and some of the small caps began to say, well, maybe we can begin to really come back upward.
I think if the shift happens in earnest, it would be painful, because if you look at what the market has been doing, diversification has not been a winning strategy, even though it is a bedrock of asset management. Bonds are not even up for the year yet. You have commodities still only up 3%. So you have a lot of households and funds that have shifted to really be overweight tech, because that's the only way you can beat the market. So if the shift is happening, how painful does it look?
Especially given what you said, the record overweights that we've seen in big tech. And it comes at a time where there's been a great deal of underweighting of small caps, even though people kind of did buy into this Goldilocks idea of disinflation without sort of falling off a cliff. How much did last week change that, Anne-Marie? And really this week going into the core PCE deflator, which is a key metric of inflation that the Fed looks at, but also personal income and spending at a time where there is clearly a softening under the way. It's just unclear how much.
Well, when it comes to deflator, potentially we're going to get really good news. This print is likely to be at the slowest pace this year. So we're talking about we're midway into the year. We actually might get some really good important inflation data. I was struck by what Robert Sockin had to say about jobless claims. They keep inching up. That's what we saw last week. Now this is at least a third week that we've seen this upside risk is now a serious crack in the labor market, and potentially is that a trend?
But, and the big but to all of this is it enough for the Fed? The Fed has been very clear that their bar is high for cutting, and that just another piece of data might not be enough because we hear the refrain, it takes months of data, and this is not yet months of this data.
And then there's a day of data, and that comes on Thursday, and then again on Sunday, and that is some of the political noise that is heating up. On Thursday, we get the first debate between Trump and Biden. A lot of people are looking to really that as the kickoff of a season that we believe has been underway for about a year now, but it seems like that will really be the true start. And then possibly even more impactful for at least the European markets. On Sunday, the French elections begin.
The French elections begin. The first of the legislative polling will happen on Sunday. And what you saw over the weekend, this FT poll, talking about the fact that Marine Le Pen's party is seen as doing better because of the economy. People are actually starting to trust potentially right-wing politicians when it comes to the economy. And I think that's going to be really interesting, because what you heard last week is investors talking about the fact that the move in the bond market we saw in France is not going away. It's basically the new normal.
And that's the reason why people are kind of watching to see what happens. 2 rounds of voting, at least in the French election. June 30th is the first. July 7th is the second. Right now in markets coming off just mild gains really across the board. You saw basically a NASDAQ that was flat on the week, and the Russell 2000 outperforming. S&P futures up, continuing to climb as the morning progresses, up nearly 0.2%, 55.42. You could see the euro gaining marginally versus the dollar after going south of 107 on Friday, 107.32, reclaiming some of that today. And you can see 10-year yield just marginally softer, marginally higher, 426.51, with crude just up about 0.33%. Coming up this hour, Seema Shah of Principal Asset Management on a stretched market, Isaac Boltanksy of BTIG ahead of this week's presidential debate, and Amanda Lynam of BlackRock with a busy week of Fed speak and economic data on deck. We begin with our top stories. U.S. stocks looking to a bounce back ahead of a busy week of politics and inflation data. Seema Shah of Principal Asset Management writing this: the potential for further equity gains may be somewhat limited from here with valuations so stretched. A soft economic landing is a necessary backdrop to support further gains. Seema joins us now. Seema, good morning. Welcome.
Good morning. Great to be here.
Great to have you. When you talk about stretched valuations, are you talking about the overall market, or are you talking about NVIDIA?
I'm talking about NVIDIA.
Okay.
Because if you look across the broad market, actually it doesn't look that stretched. We're really thinking about the pockets. It's difficult at this point, though, to look across and say, right, we need to have a broadening in the rally. But that broadening in the rally can only take place if there's still a sturdy economic backdrop. Now, we are generally quite positive on it, but we are hearing more and more clients actually really worried about the economic backdrop. Real concerns starting to creep in to the point that actually when we think about risks or we're hearing about risks, we're hearing more about what's going to happen with a hard landing than with an acceleration. And that is a very, very clear shift that we've noticed in the past few weeks.
And that's something that a lot of people are talking about. Morgan Stanley came out over the weekend, Mike Wilson, and he said he put there 3 scenarios that really counter this risk. One of them is overheating. Nobody thinks that's really going to happen. One is potential liquidity risk, and he talked about treasury auctions and some of the politics of the moment. And he said that the base case in terms of what could potentially disrupt this is, to your point, that hard landing scenario. How important is what we get on Friday in terms of personal income, personal spending, core PCE to really inform whether that's a more realistic base case?
So it's definitely important because obviously we know the consumer has been the key driver for the US economy. But you said the buzzword before, which is bifurcation, right? So you've got the really higher income households, which are essentially carrying the US economy. You've got the lower income households, which are maybe seeing a couple of strains, but because the job market is still very strong, there's no major job losses, that they can almost continue going, and those higher income households can carry the US economy. It's really, to me, it's about the labour market, because if you start to see those jobless claims increasing, if you start to see it translating to job losses, well, then the lower income consumers can no longer, or I should say the high income consumers are no longer able to sustain the US economy.
And we talk a lot about what the landing will look like. We rarely talk about what the liftoff after that landing looks like. So if we're in this environment, we get this soft landing. How important is it that growth isn't anemic, that it can take off again for a more sustained and longer term rally?
So it is really important, but actually I'm going to say something slightly different. So when I think about the landing, we think that fine, you can get a soft landing up to Q1 and Q2 next year. But to the point that the Fed starts to cut, the people who are waiting on the sidelines to buy a property, and if you don't have job losses, I worry about how does the economy react to that? You could see another takeoff and then another acceleration. So actually, I think, to me, although I know that's not what people are necessarily talking about, although the acceleration is not key at the moment, maybe as you look to 2025, that is a theme that starts to return to the market.
No, I think that's such an excellent point, Seema, because it raises this question, is the Fed going to have the opposite intended fact when they start to cut? That everyone rushes to the market and all of a sudden housing prices go up, and how policy is usually transmissioned isn't transmission the way it is. So does that mean if the Fed starts cutting, they need to start cutting aggressively in order to make sure that it is not a housing market that takes off like crazy, that there's some incentive for supply to come back in?
I think they just actually need to be really careful how they cut. I mean, I do believe that they need to have all of the evidence in hand before they start those rate cuts. They need to be very clear that there is a softening in the economy. They need to see that the labour market is maybe not showing clear cracks, but there is a rebalancing taking place. Otherwise, they risk almost disrupting the economy again, and then we're being back to the same place as we were a few years ago in about 12 months' time.
When it comes to the housing market, though, potentially those individuals that maybe they've wanted to upgrade to more space, but they're sitting on a 3% mortgage. What if all those people come into the market and then actually you have so much supply that it dilutes pricing power? Wouldn't that be almost a Goldilocks for the Fed?
It would be, but actually, I think although the supply has increased, the amount of people who are waiting on those islands, as you said, have been enjoying those 3% mortgage rates, but scared to go to buy a new property. Once they come back flooding into the market, I actually don't think that the supply is sufficient to stop the housing market from taking off again. So I think that is one thing that the Fed really needs to keep a very close eye on in order to avoid this second wave of inflation, which, look, at the moment there is absolutely really no sign of. But I think it is a risk that the Fed is very aware of, which is one of the reasons why they are so careful about the timing of those cuts.
You talk about history suggests that long Fed pauses are good for stocks. But when you look back at history and in your research, has it always been this concentrated? I mean, I look at Peter Cheer's note today, which is kind of how you started the show. Fragility in a one stock is a stock market. It's all about NVIDIA. Have we ever seen anything like that?
I don't think we've seen anything quite like this in a way that the tech gains are quite fundamental. I mean, there's something fundamentally driving it. I wouldn't compare it to the .com. But also when I look across at tech, I think they're somewhat macro agnostic. I don't think they're necessarily reliant on what's happening in the macro space. I don't think they're necessarily reliant on the Fed space. I think they actually create their own demand. At some point, that party will stop. It doesn't look like it's any time soon, but at some point it will stop. That, I think, is a very hard part to predict.
So you sound kind of bearish. What are you doing?
if I sound bearish, I don't mean to. I think that we should actually be slightly risk on, but not as risk on as we were about 6 months ago. So we do have a slight overweight to equities, but that has been pulled back a little bit because, as I said, we think that the equity gain is quite limited from here when you start to see that slight softening in the economic backdrop. And when there is so much concentration, that sentiment is starting to get a little bit impacted, where people are getting a bit worried about how much exposure they have to these very, very high, these high stocks. Within fixed income, we actually think it should be back to neutral. Investment grade is probably the area that you want to be focused on with slightly high quality, but duration doesn't look very attractive to us. At 425, especially as you were talking before about the fiscal deficit, I don't see yields coming back down too far because that term premium is going to keep thinking about the deficit.
So are you just hoovering up French bonds? Because there's extra premium there, I hear.
French bonds really scare me, and the reason is this. So there is a genuine reason I think investors should be concerned about it. The discussions that are going on could really change the deficit narrative over there. Fiscal discipline out the window potentially. But also, if you're a US investor, you've been looking at Europe in the last couple of months saying, wow, is this real? Can this really be sustained? This political disaster at the moment, which is starting to unfold, is going to scare investors again. It's going to be like, oh, where are you again? European political basket case once more. And I think that is a concern.
I feel like that just leaves us back with the US, then,
It
Seema.
does.
Is that all this is? Is this just American exceptionalism 2.0 when you buy just, not America just because it's good, but because Europe is scary?
I think the US exception is very, very key here. There are pockets around the world, so it's not like it's just the US market. But certainly, as an overweight, where are we going to be focused on? It is certainly the US.
That's sort of the reason why, as much as people want to complain about, the auctions and, the deficit, you can't really do that because it's, Europe. Seema Shah, thank you so much for being with us. Seema Shah, Principal Asset Management. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Saudi Arabia said more than 1,300 people died during the annual Hajj pilgrimage as temperatures reached about 126 degrees Fahrenheit. That's the highest level in 2 decades. According to the Saudi press agency, the majority of fatalities were unregistered pilgrims who were not authorized to participate and walked long distances without adequate shelter. There were more than 1.8 million participants who traveled to Mecca this year for the pilgrimage. TikTok parent ByteDance and Broadcom may be teaming up. Bloomberg News has learned the two companies have held talks about a potential collaboration on an AI processor. In an earlier Reuters report, it said the proposed chip would comply with U.S. trade restrictions on China. The two companies' relationship currently revolves around server and networking gear, and Broadcom has cited ByteDance as a customer in its press releases. President Joe Biden taking on Donald Trump over the topic of abortion in a new video released this morning, as today marks 2 years since the Supreme Court overturned Roe v. Wade.
Decades of progress shattered just because the last guy got 4 years in the White House. We know what will happen if he gets another 4. For MAGA Republicans, Roe is just the beginning. They're going to try to ban the right to choose nationwide.
Trump has said he believes laws over abortion should be left to the states to decide. The topic is almost certain to come up at the first presidential debate on Thursday. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the potential for Trump 2.0.
Our strategic intent is to be as strong as possible in Asia, and we got there with Trump, and it'll go back again with President Trump when he returns in 6 months.
That's coming up next. This is Bloomberg. A little more than 2 hours to the start of the trading day, trying for maybe some more record gains after 32 of them so far this year. Is that right, Danny? 32?
Yep, 32.
It's just sort of surprising considering the fact that we do seem to be kind of running out of that incredible momentum, up about 0.1% on the S&P. We are noticing, though, that the Russell 2000 outperforming once again after outperforming last week. Under surveillance this morning, the potential for Trump 2.0.
Our strategic intent is to be as strong as possible in Asia, and we got there with Trump, and it'll go back again with President Trump when he returns in 6 months. Because when the Japanese are engaged, when the South Koreans are engaged, when the Australians are engaged, and keep in mind all of these countries have raised their defense spending very significantly because of President Trump, and in Europe as well. You have to show tough love to your allies, and just like with family members, you have to be, sometimes you have to be a little tough with your family members.
Here's the latest. A new CBS poll giving former President Donald Trump a 1-point lead over President Biden ahead of the first presidential debate on Thursday. Isaac Boltanksy of BTIG writing this. The election narrative will change dozens of times between now and November 5th, but we continue to view Trump as a slight favorite at this juncture. Isaac joins us now. Isaac, as you point out, this is just the beginning. We've actually been talking about this already so much, and I'm sure that there will be many more iterations of the narrative after Thursday's debate, regardless of the outcome. That said, why is Thursday still incredibly important at a time where it's a very close race?
Good morning. Yeah, look, I think it's easy to dismiss this upcoming debate. We've seen these two men on stage. We know what that looks like, and so I understand why we're discounting its impact. But look, this is going to be an incredibly close election. This last election between these two men was decided by 43,000 voters in just 3 states. And so anything that impacts the views of voters, even on the margin, matters. And I've looked at some data and some history on this. Generally, you will see upwards of 5% shift in sentiment around debates. Now, look, using the history when comparing these two men and this race is often dangerous. But anything at the margins matters here, given that this is going to be a historically close election.
Isaac, Terry Haines came on last week and said that if President Biden does seem out of it or doesn't carry the energy that he has in the past that he did during the State of the Union, that there could be discussion of replacing him on the ballot. Do you think that is still a viable option?
Look, there's always going to be discussion of that. I think there's been discussion of that now for 2 years, and nothing has happened. And I think that's the reality here. You hear a fair amount of conjecture in town that this is the earliest presidential debate that we've ever had, in part because both parties want to see if they can replace their candidate. That is nothing more than hopium at this stage. I have seen no reason whatsoever to believe that we will see Biden replaced on the ticket. Biden himself and those closest to him believe he is the only candidate who can beat Donald Trump. And obviously Donald Trump believes that for himself as well. So look, if there is a massive gaffe or an incident or something that shakes up the race, sure, there will be more and more talk of this. But I've got to tell you, Lisa, I don't know who they're going to point to as the successor in waiting either. And so that's something that you've got to consider when you go down that rabbit hole.
Well, also, these two men are politically married and have been now for quite some time. Isaac, I was looking at some of the polling when it comes to Senate races versus the presidential race in some swing states. And you have some senators, candidates, doing better than the president. Does Biden get lifted by the down ticket, or does the down ticket suffer because of him?
Yeah, look, I think that ultimately that it's going to be a benefit in some of these states. I think what you've seen consistently with Biden during this primary in particular is a lack of enthusiasm. I think you've seen that in Michigan. You saw that in Brooklyn. You've seen that in other jurisdictions where folks were just voting no or leaving their ballots blank. And I think that ultimately how excited you see voters in states like Ohio and Pennsylvania could have an impact at the margin. To me, though, I don't think that it's going to be as meaningful in some of those Sun Belt states. They're the Sun Belt swing states where Trump is leading. That's Arizona, Nevada, and Georgia. I think for those other issues like immigration and inflation are going to be material drivers.
RFK is not going to be on the debate stage. Do you have a sense of how his votes will break in November?
No, and I don't think that anybody does. I think that that's the one of the conundrums when thinking about this election is no one knows how that's going to break. I mean, I have seen arguments from both sides that are thoughtful and detailed, but to me, this is really about enthusiasm and who shows up. And the thing that sticks in my mind is Trump supporters are loyal, they are fervent, and they show up. And so if we don't see that same level of enthusiasm from the Biden campaign, I think that ultimately hurts the sitting president. And then you have the issue of RFK, which is, first, where will he be on the ballot? Right? So we know that he'll be on the ballot in Michigan. That's one of the swing states that matter. But we need to see if he's going to be on the other swing state ballots, because let's not forget, this isn't about national polling. There are 6 states worth 77 electoral votes that are going to decide this election. So it just matters if he's on those ballots.
Isaac, on the point of enthusiasm, you talk about a loyal base from Trump that has that enthusiasm, that shows up, and Biden needs to drum it up. Is there any clear strategy to do that? Are there things that have worked in this cycle or in past cycles that the Biden team should and potentially is tapping into?
I think that's where we are in this election, is trying to figure out what are those issues that can actually drive enthusiasm. And I've looked at the issues that really excite and animate those swing state voters, these 6 states that are going to decide it. And generally speaking, there are 4 that are highlighted. One is the economy, the other is inflation, the other is immigration, and the final one is abortion. And so what you're going to see is from the Democrats is to try to shift the focus towards that 4th bucket of reproductive rights, because that is something they think is going to animate suburban women in particular, which is a key group and a meaningful group for Democrats in their get out the vote efforts. And they want to keep it away from inflation, the economy, and immigration. And you've seen some of the strategy around that showing up already with the president's immigration moves over the past few weeks, where he's trying to look harder at the border. And I think during this debate, you're going to hear a lot of the focus from President Biden on trying to lower costs, trying to focus on junk fees, which is something that they've done, try to talk about housing affordabilities and issues like that to try to be forward looking.
Isaac, I was joking with Anne-Marie and Lisa, but was kind of being serious that the thing I'm most interested into seeing is how the candidates handle a mic being turned off when it is not their turn to speak. I mean, I can joke as much as I want, but does the new format make a difference at all? You have that, you have no live studio audience, you don't have the prepared notes. How does it all play out?
I mean, look, first and foremost, I think it's deeply sad that we have to foster this element of civility here by turning off the mics and closing it to a studio audience. But if you look beyond that, I think that this is going to be a debate that's defined in a lot of ways by body language, right? You're not going to have the audible interruptions 100 times like you literally had the first time that these 2 candidates met on stage. But I think that there's going to be a lot of trying to dissect the body language from both candidates during this. And I think that'll be one of the themes the morning after, given that these mics are going to be shut off like we're in kindergarten.
I'm sure that we're all looking forward to analyzing the body language. Isaac, I am curious, though. We talk a lot about the mental capacity of President Biden and concerns around whether he appears strong, whether he appears with it. What about Trump? He's of a similar age.
Yeah, look, I think that there is fear on both sides that there's going to be a gaffe. I mean, look, there is good reason to believe that. And I think on Biden, you have 2 different Bidens. You have the Biden at the State of the Union, where that was a speech that he was prepared for. It was strong. It was resolute. He was commanding during that performance. His off-the-cuff press conferences have not been as strong, right? And so we now have that comparison there that I think that you will have a bifurcation in sentiment as you look at Biden's performance possibly on Thursday night. Whereas Trump has the benefit of being more off the cuff all the time. That is his 100% of the time personality. And so I do think the expectations are slightly lower for him because that is how he has always acted. Whereas Biden, you do have the duality of Biden with those 2 Bidens seen at different times.
Isaac Boltanksy of BTIG, thank you so much for being with us. And Anne-Marie, that goes to exactly your point that you were making when Donald Trump, when asked, are you going to prepare? This is prep. That's kind of his tone.
It feels like they're setting the bar very low on both sides so that their candidates can clear them. But I think you bring up a great point about Trump's age as well. For both of these men, these are the oldest men for major political party candidates ever in U.S. history. There's a lot of firsts going into this debate.
Which I'm sure will leave this debate incredibly discussed by all of us. Mics getting turned off, body language, all things you can look forward to. Coming up, Amanda Lynam of BlackRock calling for a shallow rate cutting cycle at a time where we just are on track for our first monthly rise in corporate bond spreads going back to October. This is Bloomberg. 2 hours away from the opening of the week of the day, we are looking at stocks that are marginally higher as we take a look at the potential for still maybe Goldilocks, possibly, we don't know yet, and whether leadership could potentially shift. We've been talking about this a lot. What you are seeing is a new trend, which is outperformance of the Russell. Can it last, as Danny's been asking consistently throughout the morning, up about 0.25%. NASDAQ down, also a departure where you're suddenly seeing some nervousness around the tech dominance, while S&P futures do manage to eke out a gain, but clawing back some of the gains from earlier this morning. In the rate space, not a lot of action this morning. The action will heat up, though, especially given the 2-year, 5-year, and 7-year auctions throughout the week. All of the yield space just marginally higher after a pretty significant rally last week, really led by, frankly, the 2-year. And Danny, this is sort of the question. Is the market moving away from the Fed and saying, you're going to cut rates? This data is giving you the confidence. Stop it with the jawboning already.
I mean, I think it's just this frustration of listening to Fed speaker after Fed speaker say literally the exact same thing, that we need more months of data. The only variation you'll get is from a more hawkish member who will say you need more quarters of data in order to know that they're going to cut. So sure, the market presses ahead, but we learned the lesson earlier this year of what happens when you fight the Fed. Are we suffering from the same thing again?
I am curious. We were talking about the yen last hour. I am curious about, frankly, the euro. Given the fact that we saw a pretty great deal of euro weakness last week, we're seeing a bit of strength this week at a time when we're heading into French elections. We were just speaking with Seema Shah and Anne-Marie. She was basically saying it's going to revive this idea that it's a political mess in Europe and you just can't go there. This, to me, might be the most impactful market action of the week.
Seema Shah literally said French bonds scare me. Called Europe, what's going on in Europe. Sometimes there's political basket cases in Europe. And she says, and that's why you have to look to the United States. The U.S. exceptionalism is because the U.S. is so exceptional, a.k.a. NVIDIA, or is it actually because there's nowhere else to go? When it comes to France, though, we've seen, obviously, the repricing in the bond market, especially the record spreads with Germany. But what really unnerves investors is if there's skepticism in the European Union, the Eurozone. And at the moment, we don't know that yet. That remains to be seen. But if there's this cohabitation, potentially we won't get there.
And we can keep saying that word just for you. You know, the idea that Marine Le Pen is actually saying she does believe in the Euro project and that won't become an issue, at least as of this moment. That seems to be a resilient concept. Under surveillance this morning, U.S. prosecutors are recommending the DOJ criminally charge Boeing. This, according to a Reuters report. The charges would be for allegedly violating a settlement related to 2 fatal 737 MAX crashes in 2018 and 2019. Neither side has commented, and the report goes on to say no final decision has been reached. Danny, how much worse can this get for Boeing?
I mean, this also puts the regulators in between a rock and a hard place because Boeing has already had a lot of bad news. They want to see this fixed. They load something else onto Boeing, a criminal charge, that just creates another headache for them. Not to mention, I mean, they're a defense contractor. I'm not entirely sure how this works, but presumably it creates a headache if the U.S. Defense Department is buying stuff from a company that has a criminal allegation and maybe even a charge.
Absolutely. They're too important to fail for the United States, not just for making planes, but also for the defense industrial base. What is interesting is that the DOJ can basically force the company to admit its wrongdoing. So will they go after that guilty plea? And that might be very, very challenging, definitely from an optics point of view for Boeing.
I look forward to the day when we're not talking about Boeing anymore. Meanwhile, Apple may be turning to Meta as it looks to catch up on artificial intelligence. The Wall Street Journal reporting the tech giants have discussed incorporating Meta's generative AI model into Apple Intelligence. Apple already named ChatGPT as a partner for upcoming AI features later this year. Danny, it strikes me that Apple's throwing everything at the wall and seeing what sticks to see who they can partner with to sort of ramp up their AI as quickly as possible.
Such a good point. I mean, did Apple just go out to every AI-ish company and say, who wants to partner with me? I think it is interesting, though, because we're in this very kumbaya period of AI. Everybody wants a partnership. Everybody is working together. And kind of implicit in some of the price gains we've seen is that it's not a zero-sum game, that a hyper-competitive, all knives out, who can spend the most and do the best, that's not going to happen. I'm not sure it can last, but the partnerships maybe suggest we have this good feeling to last for a while longer.
At this point, there is this issue of kumbaya leading to antitrust concerns. I'm just saying, if you think about Meta and Apple partnering, I mean, talk about the incredible one. Maybe it's not NVIDIA. Maybe it's an NVIDIA, Apple, OpenAI, and Meta mashup. I mean, at what point does this get people's attention?
Oh, I think it's already gotten people's attention, but it's really hard to regulate AI at this moment because no one really knows what we're going to be using exactly for. What I find interesting about the story is Apple will make money from it, from subscriptions if they go ahead with this, but Apple is notorious for being homegrown builders. So I find it so interesting that they feel this desperate need to really catch up, that they're going after, to Danny's point, literally everyone that has AI work in the pipeline.
All right. Well, meanwhile, consumer confidence and a host of Fed speak coming before the Fed's preferred inflation gauge, core PCE, due out on Friday. Amanda Lynam of BlackRock writing this: absent a sharp deterioration in the U.S. labor market, we expect only a shallow rate cutting cycle. Corporate borrowers will need to continue to navigate an elevated cost of capital environment. Amanda joins us now. And Amanda, this is a reason why I find what happened last week really interesting. And frankly, throughout the month of June, we have seen spread widening, unlike what we have seen since October. Is this beginning of a reckoning of sorts, albeit in a mild way, with this recognition of what higher for longer really means for the fundamentals?
Sure. And good morning. Thank you for having me. You're right. It's felt more choppy in the past week or two than it has in a while. We are still, just to level set, at spreads that are well below the historical average. But it does feel like for the first time in a while, the market has really been attuned to downside risks and growth. I think for the longer part of this year, it's been the resilient backdrop of growth that has allowed corporates to kind of absorb these higher debt financing costs. They've kind of moved along with it, as we've talked about before, refinanced even though rates are much higher. And I think now we're starting to think about what does that look like if we are in a prolonged higher cost of capital environment. The one kind of counterintuitive result, though, that we keep kind of focusing on is that actually we're seeing signs of either declining covenant defaults in the private credit market or declining distressed and default activity in the liquid market, which I think is really important for us to watch. At the same time, we're seeing recovery values increase. So does that mean that corporates are just kind of getting ahead of this? I think really the onus is on two things: the inflation data to come in line with the kind of good but not great expectation that Chair Powell has set. And then two, we need at least trend or above trend growth to make this okay for corporate credit.
It also raises the issue of pretend and extend, and how long can you actually do that before you run into some trouble? Oleg Malenkiev of Bank of America came out last week and pointed out that just 15% of low-quality issuers have reset their coupons so far. So even though people are talking about they're locking in longer kinds of rates and they're refinancing, that isn't the case for the most vulnerable companies. At what point does that become a true liability?
Yeah, so we're watching it in the liquid credit market, but also in the commercial real estate market. First, on the liquid credit market, we are seeing the high-yield bond market, for example, open to B- and CCC rated issuers. You're seeing a similar dynamic in amend and extend activity in the leveraged loan market. So while it may not be kind of a full force refinancing amongst the lowest rated firms, you are seeing the capital markets receptive to those borrowers. That was not the case in the second half of 2023. So that's really important to watch alongside the growth backdrop. The amend and extend activity in the commercial real estate market, I think, is probably more important. And this is using data from Real Capital Analytics. There was over $200 billion of debt that was supposed to mature in 2023 in the CRE loan market that did not. So presumably that was pushed into 2024, making that 2024 maturity wall closer to $800 billion, not $600 billion. So that is something that we're really watching, because that I would view as a short-term Band-Aid. I think we can all agree that when CRE loans are coming to be refinanced, they're doing so in a much more punitive environment, both based on the rates, but also lending standards and bank lending appetite and structural shifts. So that, I think, is probably the bigger focus. Now, for our part, we think that's a longer kind of slow-moving dynamic. I think the banks are trying to get ahead of that and saying that they're properly reserved. But I think when I'm thinking about amend and extend activity being a risk, I think it's probably more in the CRE market, because right now the syndicated debt markets are open to these borrowers. As you know, that can change quickly, but I think it's been comforting.
Well, okay, so a couple of things to unpack there. Just on the real estate developers. So, okay, if we're still in this moment of extend and pretend, the maturity wall looks steeper. Let's say we just get one cut from the Fed in December. So you say it's slow moving, but what exactly does it look like?
So I don't think one cut or two cuts over the next several months is really game-changing for liquid credit, private credit, or CRE. I think the direction of travel and kind of giving some clarity to the market is very helpful. So in CRE, as you suggested, that could help the price discovery process, because there you could have buyers and sellers come into more alignment on what exactly that rate environment might look like. I would say we probably have more clarity on that now than maybe even 5 weeks ago when we were talking about the potential for rate hikes. And so I think on the margin, it could improve some clarity in that price discovery. But I don't think it's game changing for borrowing costs. And of course, in certain subsets of CRE like office, you have structural shifts in terms of office utilization. I will say CRE cannot be painted with a broad brush. There are parts of CRE that are doing very well: hotel, self-storage, industrial, even parts of multifamily. So this is very nuanced, very regional, but I do think it's more about buyer and seller expectations coming into alignment in the event of 1 or 2 rate cuts, as opposed to a wholesale rate relief. We're not expecting near-term significant interest rate relief.
Well, you also mentioned that the syndicate market is very much so open. Desks calling for something like $20 billion worth of issuance this week. So that continues in a large force. But as Lisa mentioned, spreads are starting to widen. So at what point, and are we close to it at all, where spreads widen enough that you get some of that issuance seriously backing off?
I think the bar for corporates to stand down if they have defined refinancing needs is very high, because I think they're looking at event risk in the second half of the year. And I think that it would behoove them to move forward, even if they're leaving something on the table, so to speak, in terms of spreads. We've seen periods of time where the high yield and IG markets have tried to sell off and actually buying has come in. I think really it's more about kind of the risk off tone of the market and uncertainty as opposed to an incremental cost. If a corporate feels like they can't get a deal done, I think that is a reason to step down, but I think those instances are few and far between. I think embracing this higher cost of debt is something that we've seen, frankly, over the past year, 18 months from corporates, and I think they'll continue to do that.
When you say you can't look at CRE as all the same, they're not created equal, what gives you the most concern?
It's really that central business district office where, again, if you use that same real capital analytics data, prices are down around 45% from 2019 using that index level data. And that's even worse than suburban office, for example. So it's really kind of older, obsolete central business district office that's not being utilized and that is really trying to have to fight for vacancy. I think we haven't yet seen the price discovery come through, because in real estate, you actually need transactions to trigger appraisals, and volumes are just still very, very muted. And so we haven't seen that flow through yet. We often think about kind of what inning are we in. I was operating under the assumption that we're maybe in the 6th or 7th inning. There are some folks who I really respect who think we're much earlier, the 4th inning. And so I think that is going to be a longer term trend. In the financial crisis, which I don't think we're anywhere near that sort of analogy, it took 34 months for a peak to trough decline. So I think we should be expecting this to be at least a few more quarters.
Since you are expecting turmoil ahead, I want to end on private credit and this sort of asset class that really has grown up post-financial crisis in the wake of some of the regulation that's pushed a lot of the asset class out of the big banks. And I'm wondering how much you see untested managers acting in ways, loosening up covenants, being perhaps a little bit more bold or risky in their behavior. Will there be some sort of washout or reckoning in the next 12 months as people realize this high rate environment is here to stay?
Right. So the idea of kind of throwing underwriting discipline to the side to capture market share is something that we're watching very closely. The stat that gives me comfort, however, is from Preqin, and it's that actually new entrants in private credit have raised around 2.5% of total capital since 2022. If you looked at that same stat from 2019 to 2021, that number was in the high single digits. So what is that showing? That's showing that the market's more discerning in where it's allocating capital. Private credit managers with 4 or more funds, by contrast, have raised 85% of capital since 2022. So I think that's saying that as we, and by the way, that same figure looked different in the ultra low rate environment of 2019 to 2021. So it's showing you that the market is becoming more discerning in where it's allocating capital. Could there be losses of those new entrants in private credit? Absolutely. May some of them be consolidated? Probably, yes. But does it cause a systemic risk to the financial system? I don't believe so, simply for the fact that they actually haven't been that successful at gaining large amounts of capital.
Amanda Lynam, thank you so much for being with us. Wonderful as always. Amanda Lynam of BlackRock. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Hackis. Yahaira.
Hi, Lisa. Israeli Prime Minister Benjamin Netanyahu says forces will soon end the intense stage of fighting in Gaza and will focus on targeted operations against Hamas. In his first major interview with an Israeli media outlet since the October 7th attacks, Netanyahu also directly rejected for the first time the prospect of a ceasefire deal with Hamas that could eventually lead to the end of the war. Target is partnering with e-commerce specialist Shopify to expand its marketplace for third-party merchants. Target said vendors using Shopify's platform can now apply to sell their products on Target's marketplace named Target Plus. This is the first partnership of its kind for Target Plus, as a retailer looks to catch up with larger competitors like Walmart and Amazon. And Bitcoin is extending its drop after crypto suffered one of its worst weeks this year. A gauge of the largest 100 digital assets fell about 5% in the 7 days through Sunday, the worst such decline since April, according to data compiled by Bloomberg. In earlier trading, Bitcoin fell as much as 4% to a more than 1 month low. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Boeing facing more headwinds.
Our culture is far from perfect, but we are taking action and we are making progress.
That's coming up next. This is Bloomberg. Next up for this market is probably core PCE on Friday, as well as the Thursday presidential debates. Until then, we get a lot of second-tier data or third-tier data, whatever you want to say, including home price data, which will be analyzing significantly. Right now, you are seeing gains to start the week, at least in pre-trading activity. 55.40 on S&P futures, just nudging up about 0.1%. The euro clawing back some of the losses, some of the weakening of last week, gaining versus the dollar 107.28. Yields marginally higher going into a slew of auctions, 2-year, 5-year, and 7-year tomorrow, Wednesday, and Thursday. 426 on that 10-year, and crude prices up about 0.5%, $81.09. And I have to say, Anne-Marie, a lot of people focused on just what's going on in domestic politics, but internationally, it does seem like there's sort of a heating up of Hezbollah in the north of Israel and what that could mean in a broader sense.
Well, Netanyahu said this. He said that that's going to become increasingly more of a focus for Israel. And then we had the chairman of the Joint Chiefs come out and say if Hezbollah and Israel were going to expand in their skirmishes and it was going to get ramped up, Iran would come to the backing of Hezbollah, and then everyone starts to worry about, will this trigger a more widespread conflict in the region?
Which has always been a big fear, although it has been kind of shrugged off increasingly, maybe to a fault. Under surveillance this morning, Boeing facing more headwinds.
Much has been said about Boeing's culture. We've heard those concerns loud and clear. Our culture is far from perfect, but we are taking action and we are making progress. We understand the gravity, and we're committed to moving forward with transparency and accountability.
Here's the latest. Reuters reporting that U.S. prosecutors are recommending the plane maker face criminal prosecution. The charges would be related to 2 fatal 737 MAX crashes in 2018 and 2019. Bloomberg's George Ferguson joins us now. George, I love speaking with you, but I look forward to the time where we don't have to talk about Boeing again and again, because it really does seem to be this sort of anxiety-producing drone. I'm sure you feel the same way. How much is this sort of reprising the idea that there aren't the same kind of oversights at Boeing, even to this day, despite warnings that date back as early as 2018?
Yeah, I think it is pretty surprising, right? Because I think coming out of the MAX grounding and those crashes, the crashes obviously beforehand, I would have expected they would have worked pretty hard to put all of those, all those controls in place that they were asked to do. So I think very surprising, and just another indicator of the challenges at the company right now.
George, does it give you a sense that this is basically a government that has its hands tied, simply because it can't really neuter a company that is of crucial national importance and really has a monopoly on the industry at a time when it is shown again and again that it doesn't seem to be able to put in place the necessary safeguards that even regulators have asked for?
Yeah, I mean, I think that I don't think the regulators' hands are tied dramatically. Like, I think they can get in there and do a bunch of work with Boeing to try to make sure they implement what they've asked them to do, the oversight they've asked them to do. I just think they want to be careful as far as, financial fines and anything that would impede their ability to compete. I mean, Boeing right now isn't on the best financial footing, right? They've got about $17 billion in cash. They've been burning cash pretty heavily. We're looking for them to, they've actually indicated, and we're watching to see if they can really ramp up production in the back half of this year to start generating cash, because they can't really survive at the levels they are right now. So I think the regulators have to be careful from that perspective, but from the oversight perspective, I think they can go all in on this.
So does that mean potentially a monitor that can come in and look after the company, the financial penalties you discuss potentially likely, but the DOJ can also require the company to admit its wrongdoing by pleading guilty. What would that mean for Boeing?
So, I mean, I don't know how you make them admit they're wrong. I think they sort of have to come to that point. You got to prove it in court, but I think that's kind of a moot point at this stage anyways. I think that people understand that Boeing, had problems with MCAS. I think they've kind of admitted it. And so I don't know that would matter much to the company's financial performance or perspective in the marketplace, what people think of them. I kind of feel like that's sort of moot at this point.
Right. The damage seems to already be done. George,
I think so.
Can you give us an update on where they are with the CEO search?
I wish I could, but we don't know, right? We know that they've been in the middle of this search. We've watched some people take their name out of contention. It's a pretty rough job. I think we saw from Dave Calhoun's testimony in Washington, D.C. I think it was last week. The weeks blur together after a while. It's a really difficult job. There's a lot of questions to answer, a lot of work to be done on the factory floor. So I just keep coming back to they're going to need a real rock star from a manufacturing perspective. I think they're harder to find right now in America, but I think that's what they need, and we're not hearing much out of the company at all about where they are in that process.
Now, in that process, okay, because you talked about, some outsiders, Larry Culp from GE being one of them that was early floated as a name. Wall Street Journal reports he doesn't want the job. You need a manufacturing rock star. George, does that come from inside or outside of the company? Because an outsider would face the complexion that is the beast of Boeing, and an insider has been during Boeing during all of these problems. So where do they pick the CEO from?
I personally think it comes from outside the company, right? I think you do need a fresh look at the manufacturing processes. I don't think you need, it appears that there's been a breakdown inside Boeing in sort of that core manufacturing, core oversight of employees training. So I think you need someone to come in who's done it very well somewhere else. And it seems like there is a problem with Boeing culture. And so I don't know that you'd want to pull out of that culture.
Bloomberg's George Ferguson, thank you so much for being with us. And hopefully the next time that we talk to you will be about airline trends and other things other than Boeing's malfeasances that seem to be coming up time and time again. I say this because, honestly, we talk about the travel season, right? And we talk about how all the U.S. Consumer, particularly the well-heeled one, is heading over to Europe. This is what we should be talking about, right? Is sort of the demands for the crowds. This in the Wall Street Journal. Americans are all over Europe this summer. Here's how to outsmart the crowds. I mean, at what point are people just not watching anymore?
Oh, what were their ideas for outsmarting the crowds? I need to look at those tips before I head back to Europe at some point. We are seeing this resurgence, though, in travel. It feels huge this summer, and yet the concerns are, of course, about how safe is it to travel right now when you get headline after headline about Boeing, but are people just holding their nose and getting on the flight?
I mean, do you really feel worried about it? I feel like when I was a child, I was worried about flying, and then I just sort of shrugged it off and said, I'm probably riskier going out in the sun, and I might get, melanoma. I mean, at a certain point, it's sort of how much are we just sort of being
riskier to drive?
Yeah,
it is
exactly.
much riskier to drive.
And
for people who have really intense flight anxiety, they tend to get something prescribed, and they can deal with it too.
Well, there you go. Advice if you're going to Europe or trying to travel from Danny. Get that. medication. Coming up, Venu Krishna of Barclays, Tom Narayan of RBC, Vishy Tirupattur of Morgan Stanley, and Stephanie Roth of Wolfe Research. Really interesting from Vishy Tirupattur talking about credit markets and the role that they play within artificial intelligence, in addition to some of the trends that we were talking about with Amanda Lynam. Right now in markets, you can see a sense of a bit of a pullback from last week, the idea that maybe we can keep those gains going, albeit the same trend. And this is what we're going to be watching. Can small caps continue to outperform as some of the big tech beloved behemoths lose favor with an increasing number of people? This is Bloomberg.
The first time this year, the market is starting to get nervous about the potential or higher probability of some sort of harder landing.
All equity markets are at a risk simply because you are at the point where the unemployment rate in the US is very low, is starting to pick up.
It's clear to me that we're going to see slower growth over 2024 relative to 2023.
It was only a couple months ago where the narrative was re-acceleration even, but I think the data now have more clearly slowed.
The market is expecting this slower growth and inflation outlook. That doesn't mean that you're going to have a hard landing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Is this the beginning of the end of big tech dominance? Right now, welcome back. This is Bloomberg Surveillance for our audience worldwide. Good morning. Danny Berger, Anne-Marie Hordern, Lisa Abramowitz. Jonathan Ferro is off until, I believe, Thursday. I begin saying it's a little overdramatic. Is it the beginning of the end of the sort of big tech dominance? But that's really the ultimate question that we ended last week with. Suddenly, for the first time in a long time, small caps were outperforming and big tech showing some real nervousness that maybe they can't keep climbing to the sky.
That's going to be the important thing for the bulls. If tech dominance stops, can the rest of the market catch up? If you look at what the market's done so far, the things that have done the best quarter to date, it's utilities, it's staples, not exactly ringing endorsements for this economy.
Which really speaks to this question of, are we seeing a softening that's welcome or a softening that's not welcome? Later this week, we do get core PCE deflator, that key inflation metric that the Fed looks at. We also get personal income and personal spending. This is really the key question. How much can the American hedonism engine of consumerism really continue to propel this economy?
Well, this is the big question alongside jobless claims, which we have been ticking up. And what everyone's trying to look for is the disinflationary story, some of the cracks seeing in the labor market. Is it going to be a trend enough to put a rate cut earlier than what potentially December, which some people are looking at September? And then there's some big wagers in the market for potentially July.
You know, I have to say there was one report over the weekend that really caught my attention. And you were talking earlier, Anne-Marie, about bifurcation of the consumer, of how the high-end consumer is the one that's really been propelling all the spending, and the reason why we have this article that is a little obvious about what you can do to avoid the crowds in Europe if you're an American traveling there. There was this report from Torsten Slok of Apollo. The median expectation for inflation was substantially higher than the average. Basically, what he looked at, Danny, was this idea that the lower end consumer is actually expecting inflation to climb dramatically over the next 5 years in a way that maybe the higher end consumer isn't. This sort of speaks to maybe on the margins, inflation expectations are becoming unmoored in certain segments of the population. How long could this sort of divergence continue?
And can the Fed cut if there's this concern about inflation expectations getting entrenched? If you have this whole swath of the population who thinks inflation is going to be 5% or more in 5 to 10 years out. The one thing, though, is can there still be disinflation even if that's the case? If you have middle income and lower income consumers who have pulled back on spending, even if the upper end is still traveling, going to Europe, still spending, you probably can still get disinflation. So it's how much do those entrenched expectations bleed into their habits?
And how much does a rate cut reignite a housing market with people still looking to get in, but people not looking to get out of their houses as quickly enough to offset some of the pent-up demand? Right now, the way that it's shaking out in markets is at least the divergence on the margin is continuing with stocks basically futures unchanged, 55.34, completely flat. You can see the Russell 2000 still outperforming, albeit, it is just a fraction of the size of the Magnificent Seven. I will just note that in terms of size. Euro gaining versus the dollar, just about up about 0.4%, 107.33, strengthening. 10-year yields higher higher, just about a basis point, 426.90. And crude up about 0.4%, $81.80 at 8 cents, traded on the NYMEX. Coming up this hour, Venu Krishna of Barclays on why a broad market rally, as we were just talking about, is still possible. RBC's Tom Narayan on why Tesla's robotaxi bet might not pay off, at least not as much as people think. And Stephanie Roth of Wolfe Research looking ahead to key data, including the PCE deflator. We begin with our big story. Stocks looking to make a comeback ahead of a busy week of data and key earnings. Venu Krishna of Barclays writing this. A question we've heard recently is, what will it take for the rally to finally broaden? We continue to think earnings growth is the key. All in, big tech and the rest of the S&P 500 are expected to deliver similar earnings per share growth beginning around year-end. Provided the macro backdrop remains supportive, we think this could go a long way toward justifying a broader rally. Venu joins us now completely on cue, because this is really the key question right now at a time where it seems like on the margins you're beginning to see a broadening out. A Russell 2000 that's outperforming as people kind of pair some of their bets on big tech. Why do you say earnings will really determine the trajectory of this going forward?
Good question, and thank you for having me. So I think the first question is, if you look at what the channels obviously for returns are, it's valuation and it's earnings. On the valuation front, our view is that we are fairly fully valued. Whether you break it up into big tech or rest of tech or rest of S&P, we think, in fact, that that being a channel for returns is limited. But what we did see in the first quarter earnings was big tech earnings accelerated even further, not just realized, but forward estimates. But finally, for the rest of S&P outside of tech, we saw revisions moving in the right direction. So big tech moved from forward guidance of around 10% to 20%, so it's phenomenal. And the rest of the market moved from around 2% to 5%. So finally, we're beginning to move in the right direction, even though the delta between the two is massive.
I guess when you're talking, I'm thinking why? Why is some of the profit expectations increasing at some of these smaller or more leveraged companies? Rates aren't going down. The consumer, people say, is weakening. We got some weaker than expected economic data pretty consistently over the past couple of weeks. Why are earnings actually managing to increase, at least expectations, for some of these smaller, more highly leveraged to the economy companies?
Sure. Just to clarify, it's not about small caps. It's the rest of S&P. Right? Because S&P itself is so concentrated and so bifurcated, so we don't even have to go till small caps. In fact, our view has been, we've been negative on small caps for over a year, and we have not changed our view. Even though this whole broadening trade has been the most popular trade on Wall Street for 9 months, and we've been on the opposite side. We still remain on the opposite side. So we still think it's large caps over small caps. So to answer your question, I think it is all about what you figured out from first quarter earnings, right? And there, for the first time, not only did we see margin continue to improve for the third quarter in a row, but for the rest of S&P also it incrementally nudged in the right direction. And so, our view always was the last 3 quarters, the final improvement in margins was all concentrated in tech. So even now, it is dominantly concentrated in tech. But there are some glimmers of hope. But that said, our view is that we want to wait and watch for the broadening to take place. That's why we remain kind of skeptical on the borderline. And that is because it is just 1 quarter. Right? And we are beginning to see cracks in the consumer. And which means that companies which took advantage of COVID as a one-time opportunity to raise prices without fear of a competitive reaction, now are finally facing a situation where final demand can be moderating a little bit and consumers are becoming more careful about where they spend the dollar, marginal dollar at least. So we think that does translate into some sort of margin pressure. And surprisingly, I think where the equity and markets need to pay attention is that compared to historical, the way the market reacts, some of the more defensive areas in the market are the place where there is still some margin pressure, especially staples, right? And so if things were to go wrong, the kind of protection expected from staples may not materialize. So this is a fairly complex market. Like I say, highly concentrated and yet very high dispersion. It means it's a stock picker's delight, but they are struggling to outperform the market. Less than, I think, 20% of funds are actually outperforming the market. So this is a tremendous challenge.
I was going to say, Venu, why would I buy anything other than a passive S&P 500 fund right now? Because it will capture all that upside of the larger companies who keep getting larger. And presumably, if you're an active manager and you're outperforming, you're even more overweight those companies. So how does an active manager even try to get fund flow in a time like this?
That's an excellent question. So to give you a sense, we've been positive on big tech since the fourth quarter of 22, and we haven't changed our opinion since then. And to your point, when we get asked this question about asset allocation, in fact, it's the question we had just recently, and this is what I told them. And even I'm not an asset allocator, right? But I'm just being intuitive in terms of, right? You can have the market exposure to big tech, right? And by the way, correlation between those stocks is 40 to 50%. In other words, you can nuance your opinion within those 6. The correlation of big tech to the rest of the market is only 20%. It means dispersion is very high. You can go and look outside, right? So I think it's the way you construct your portfolio. And then on the front end, on the cash market, you're still earning 5.35%. So I would say put 20% of your cash in front end, keep rolling it, because even if rate cuts come, you're still going to be in the 4s by the end of next year, right? Maintain your market exposure to big tech and play around on the margin a little bit, and then you're left with roughly 40%. Knock yourself out by trying to be an active picker, and then go and find the value because dispersion is allowing you to do that.
First of all, I love that you still see cash having a place in a portfolio.
Absolutely.
Because there's lots of people who have come on, I know this program, and have said it's time to look away from that.
Mainly credit folks.
Mainly credit,
yes.
Yeah, so maybe a tiny bit of book talking. But okay, with all of this, you mentioned things like staples are no longer your safety. So where do I get safety? If I am not just buying the S&P 500, I want to turn to an active asset manager. Where should I be finding a safety trade that can be my ballast in an equity portfolio?
So let me give you one approach of doing that. So that's exactly what we tried to answer recently, saying that you can't get stuck in 6 stocks, right? It is getting scary because concentration by any metric you look at is in the extremes. So one approach we looked at was, why is big tech doing very well? So on a host of fundamental metrics, they're killing it. So we said, how can we try and look outside in the 494 stocks and try to approximate those levels of financial metrics? So you cannot replicate it, but you can try and come close to it. And if we take a diversified approach, we actually managed to pick about 50 stocks in the rest of the 494 stocks. And our hope is we're going to rebalance it every month and see how that's doing. So I think this is not a sector-oriented market, because traditionally in asset allocation, or 80% of returns come from the sector, but we think that's not the kind of amount. You want to wear a growth hat, a quality hat, and then scour the market, keep it diversified because you're trying to avoid concentration, but keep your exposure to those big 6, keep your exposure to to cash, and then play around in the middle with that 40-odd%.
Your notes reflect some conviction you have. I want to ask you about the presidential election. Lori Calvasina was talking about this paralysis investors may feel. But you have conviction on potentially what we may see after November. How do you prepare equities for that?
Well, you cannot prepare for it, right? Because the point is that it's a close election. It can go any way. But you can just look at history to get some sense of how the market has behaved. So interestingly, historically, if you look at how markets behave, returns during election years actually behave less than the prior years, in normal years. Second is when Democrats win, typically we have found that in the first year, returns are better. But on the other hand, when Republicans win over a 4-year period, returns are better, right? So I think the biggest thing right now is focus on what policies they're touting and try and see what the impact on the market is. That's what we tried to do recently. So if you have a Trump regime, for example, and if they follow up on some of the tariff discussions where 60% on China, 10% across the board, rest of the world, and we assume that what if the world also retaliates? They will, right? So they're not going to be sitting and taking tariffs from our end. So that impact on earnings, we think, is going to be almost 4% in aggregate. On the other hand, if you have taxes, and if Democrats come and there's a blue wave, which we think is highly unlikely, and taxes somehow go to 15%, there's a tailwind of almost 3.5% to earnings. But you flip it and you say Democrats come and they raise taxes to 28%, then your hit to earnings can be almost 7.5% based on taxes going up and the taxes on buybacks. So I think it's a mixed bag. If you have a red wave versus a blue wave, but our view ultimately is that it's going to be a divided government, and that will act as a balance from some of the more extreme measures, and the market will do fine. Politics is we talk a lot about it till we enter it, and then we move on with our lives.
Unless you're France. Venu Krishna of Barclays, thank you so much for being with us. Venu Krishna there joining us. Let's get to an update now on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hakas. Yahira.
Hi, Lisa. NVIDIA shares are falling in the pre-market as the stock is set for a third session of losses, putting it on track to wipe out nearly $300 billion in market cap. The stock has surged this year, propelling the company to briefly become the world's most valuable, a title it's since lost after the latest drop. NVIDIA's market cap is now below both Microsoft and Apple. Also falling, Bitcoin. It's extending its drop after crypto suffered one of its worst weeks this year. A gauge of the largest 100 digital assets fell about 5% in the 7 days through Sunday, the worst such decline since April, according to data compiled by Bloomberg. In earlier trading, Bitcoin fell as much as 4% to trade at a more than 1 month low. And tomorrow's sports, the company co-founded by pro golfers Tiger Woods and Rory McIlroy, has secured backing from Dynasty Equity Partners. The funding round values the company at about $500 million, according to people familiar. Tomorrow's first project is a partnership with the PGA Tour for an indoor golf league known as TGL, which is scheduled to launch in January and air on ESPN in the U.S. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the morning calls. RBC's Tom Narayan cutting his Tesla price target on lowered robotaxi estimates, talking about maybe the profitability just won't be there as much as people previously thought. That's coming up next. This is Bloomberg Surveillance. We are still talking about traveling to Europe and summer plans because that seems to be where people's minds are. Welcome back. This is Bloomberg Surveillance. We have been looking at a market trying to find its footing after really seeing that rotation under the surface. We did hear a bit of caution this morning from RBC Capital's Lori Calvasina as well as Principal Seema Shah. Question around what we just heard from Venu Krishna talking about, yes, maybe there are some things to like with under the surface, but their benchmark base cases for declines going into year end. Time now for the morning calls. First up, TD Cowen upgrading Planet Fitness to buy with a price target of $92. The analyst saying the company has, quote, compelling catalyst path, naming it a top small mid-cap idea. Next up, Baird raising its price target on Micron to $172. The analyst noting the chip maker's rising exposure to the latest so-called high bandwidth memory technology, seeing high gross margin and pricing potential. And finally, RBC cutting its Tesla price target to $227, but maintaining an outperform rating. Analyst Tom Narayan lowering estimates for the company's robotaxi venture, expecting more competition than previously thought. However, Narayan still seeing the robotaxi as the biggest driver of valuation. Tesla is expected to unveil its long-promised autonomous vehicle on August 8th, which is really a key feature to the robotaxi discussion. Tom joins us now. Tom, wonderful to get your take on this. I want to start with why the robotaxi is so essential to Tesla's future at a time when electric vehicles are still being sold and they've managed to actually do all right in China.
Yeah, I mean, you can't get to their $700 billion valuation on just a car business. It's just mathematically impossible. The way you get there is through autonomy, which is FSD to some extent, but it really is the robotaxi business. It's a very high revenue business. The utilization for miles traveled goes up way more than a regular private car, and it increases the total addressable market in the transportation industry, taking share from planes, from trains, giving people with disability, children access to mobility. So from just a TAM basis, it increases the overall pie for transportation. And that's really why Tesla is going after this so aggressively.
And it is the idea of a robotaxi, one without a driver that can go around. San Francisco, I believe, had some of these by GM in testing form, but then had to pull it back. Your big issue, at least with the valuation, is that you don't think that this is going to be as profitable as many people, including yourself, previously thought. Why? Is it competition? Is it just demand and kind of where consumers are willing to spend?
Yeah, it's interesting. When I did this price target cut, I got a lot of pushback from Tesla bulls thinking that I don't like robotaxis or something. It couldn't be farther from the truth. I still give them $400 billion plus of value from robotaxis. It's over half of my entire valuation. It's just that compared to what I had thought before, I've lowered my pricing assumptions with the help of our internet team who covers the ride-sharing companies Uber and Lyft. And I've also reduced the amount of revenues they get outside of their own walled garden for things like software. And I do believe ultimately the app, right, Uber and Lyft, those guys will have a lot of power, a lot of say in the future of robotaxis. There will be other players in the market, others making cars, software, other apps. But I am still very bullish on robotaxis for Tesla. I have them getting over 20% market share in the US. That's 70% of my robotaxi valuation is their own walled garden, their app, their car, their software. It's just that I've lowered the non-Tesla portion of my valuation because I do think there'll be other players. This will be a very regulated market. Government's not going to just allow one player to, dominate everything. That's why I think pricing comes down. And I do think other players will play a bigger role as a result.
Well, Elon Musk has thrown some pretty big numbers out there, Tom, when it comes to what valuations he thinks Tesla will be when it comes to the robo-taxi. I want to ask you about a different number, he said. This was at their shareholder meeting earlier this month. He said that Optimus, which is their robot venture, could lift Tesla's market cap to $25 trillion someday. What do you think about that?
Well, I mean, certainly a lot of things could happen, right? And so I'm not discounting that at all. It's just that, my valuation looks at businesses that they already have, energy storage, obviously the car business. I give them credit for robotaxis because of the leadership they have in FSD, full self-driving, which I do think is a precursor for what they'll eventually do in robotaxis. So currently, I don't have the robot in my valuation. We'd have to see more evidence of it to see what that really looks like. But yeah, I mean, this is a name that has a lot of upside potential. So I'm just looking at what we know today, and that's what I'm using to get my valuation.
When you talk about competition coming to this market, do you mean EVs coming from China, Tom?
On robotaxi specifically, I just mean other players making robotaxis, right? So, just look at the ecosystem of regular taxis today, or even when you use your Uber app, different OEMs are sending a car to you and you're getting inside that car. I do think they're going to be the biggest player in the US, but look at China and then look at Europe. I don't think Tesla will dominate China. China's going to want to have their own national champions and potentially so in Europe as well. So it's more to do with the fact that I think the overall robotaxi ecosystem will be fragmented. There'll be a lot of players. I do think Tesla will be a really strong player, especially in the US. But it's just to note that in the robotaxi ecosystem, especially since the government will regulate these markets, I don't think they'll allow for, one ring to rule them all, a monopoly or so to speak. I think there'll be a lot of different players, and that's something that I wasn't really accounting for in my prior valuation.
Just real quick here, Tom, which other auto manufacturer do you think is going to present a real competitive edge versus Tesla in this field?
I don't know if it'll be like another, like a duopoly type thing. I think it'll be fragmented, right? It'll be OEMs with theirs using, let's say, Mobileye software or somebody else's software, or it'll be, the app will have a strong play, and that could be Uber and Lyft, but with different OEMs. And certainly today we know Waymo, GM Cruise are strong players in this. I don't see why they couldn't participate in it as well, but it's too early to tell, I think, outside of Tesla, who will be strong players. I do see it being a fragmented market with different types of players doing different things. Tesla will have, I think, a walled garden approach with the total ecosystem, but that'll be some portion of it. So it's not really like there'll be another company that will, rival necessarily Tesla. It's just there'll be a series of different players coming at it from different angles.
Tom, thank you so much for being with us. RBC's Tom Narayan there on his call. It still is bullish on Tesla. Let's be clear. His price target isn't exactly calling for it to go down, just not up as much as previously. We also, I got to say, I'm actually really looking forward to robotaxis. I don't know, people who are saying not so
2040,
much.
that's when the global adoption people think it's going to happen.
Get me one with a gym inside. Love it.
Okay,
Go on a
well,
run.
You have
Perfect.
You have a whole other vision right now of what exactly a robotaxi is. Where does a gym come from?
Just put a treadmill in there. It could work.
All right. Coming up next, Morgan Stanley's Vishy Tirupattur and Stephanie Roth of Wolfe Research. You're watching Bloomberg. About an hour until the open of the trading week to the last week of the month, as the last week of the half of the year of 2024, which has seen a whole host of different narratives. Current narrative, unclear. Is weakening weakness? Do we see a rotation under the surface? Right now, the answer is yes. S&P futures up about 0.1%. NASDAQ down about 0.1%. Danny, the Russell 2000 up 0.3%. I'm thinking about what Venu Krishna said. It's not just the Russell 2000. But in general, maybe some of the profit estimates for big tech have gotten over their skis, and the profit estimates for the rest of the 493 just aren't high enough.
Yeah, I mean, even with the bigger profit estimates for tech, I mean, there's been some pretty incredible multiple expansion. PE ratios have gone up something like 20 percentage points this year. I think it's more like 50 if you take it from October. That's not really earnings based. That is momentum. That is just plain and simple multiple expansion. So when you talk about the market turning, it could be that. Maybe we just jumped the shark a bit.
Well, right now, a lot depends on what happens in the rate space. And what we see in the rate space is just marginally yields up after last week having a pretty significant rally across the board, just about a basis point for 2 10s and 30s. Anne-Marie, we do get 2-year auction tomorrow, $69 billion, 5-year auction, $70 billion coming on Wednesday, and 7-year notes coming out, $44 billion of them on Thursday. You pointed to a number of estimates talking about the concern under either Biden or Trump if we get some sort of deficit expansion. And that's one reason, especially ahead of Thursday's debate, that I think some of these auctions might be pretty important.
Yeah, and you have the Committee for Responsible Federal Budget this morning putting out that they're going to be tracking all of this, what these candidates say regarding spending and what that could mean for the deficit. The issue is whether or not it's Biden or Trump. I don't know how many times I'm going to say this, but the deficit is going to rise next year, especially when they're going to have a massive tax fight in Washington, D.C. And it's why more people are coming along to your side, Lisa, and they care about the auctions.
They do care about the auctions, but then they look over at France and they say, just kidding, as the European auctions say, hold my beer. Meanwhile, what you do see in the currency market is a little bit of backing away from dollar strength, both when it comes to the Euro region as well as versus Japan. Here we're talking about retracing some of the weakening that we saw from last week, higher by about 1/3%, 107.30. The U.S. Japanese yen cross, to me, and Danny, you pointed to this earlier, is fascinating. The idea of dollar weakness versus yen strength, marginally so, coming after the release of some Bank of Japan meeting minutes, highlighting the interest in even raising rates again, just to stave off some of the weakening and amid warnings of intervention.
Yeah, throwing literally everything at the wall, and it does not work. The yen is still stuck around 160 per dollar. This market wants to see rate hikes. They don't want to see talk of rate hikes. They actually want to see it. And I'm sorry, it only just got pushed back after the last meeting where they didn't do anything with their bond purchase program in terms of laying out details. So the market says, great, we didn't get details. We're going to need to get those first before you hike. So we're just going to wait. We don't care what Conda says about intervention now.
I wonder how much pressure there's coming from people who are sick of seeing American tourists. And they say that the longer that the dollar remains strong, the more tourists we're going to see. Come on, Bank of Japan, get going. All right, under surveillance this morning, another reckoning for Boeing. Reuters reporting that U.S. prosecutors are recommending that the Department of Justice bring criminal charges against the plane maker. Those charges would be related to a violation of a settlement related to 2 fatal crashes. Beyond an original 2021 fraud conspiracy charge, it just gets worse and worse. Sources are still not specifying which criminal charges the DOJ could be considering. Amish, you're talking about this earlier. Just, how far can the Department of Justice go, given concerns about financial viability, given the fact that this is the preeminent plane maker of the United States?
Too important to fail. We've talked about this a lot on this program. George Ferguson, when he was talking about with whether or not the DOJ could almost force Boeing to basically say, yes, we're guilty, Optically, it's bad, but to his point, the damage is already done. So two potential things we can see, and Reuters talked about this. Of course, there could be financial penalties, but also a third party to come in and monitor what the company is doing and if they are complying. You'd have to think, why haven't they actually done that already?
Yeah, how many months has it been now? 9 months or something since the
Too
latest?
many. Yeah.
But a number of years also from 2018 and 2019. Meanwhile, TikTok's parent company ByteDance and chip designer Broadcom are in talks to develop an advanced AI processor. Sources familiar with the discussions say that the proposed 5-nanometer purpose-built chip would comply with U.S. trade restrictions on China. The two companies haven't yet reached a deal. If they do, the chip would reportedly be made by TSMC. Danny, to me, this is fascinating story because everyone's talking about geopolitical risk, the idea of cross-border insulation when it comes to artificial intelligence in the tech world. And then we see Broadcom partnering with a company, an entity that's supposed to be banned in the United States if senators have their way. How do we make sense of where some of the currents are and how this really factors together?
It definitely feels like a Broadcom that's being careful. They're carefully crafting this deal so it can fit within U.S. regulations. When they announced that they had a new chip customer, they didn't say its name. To me, Lisa, this really speaks to the fact that these chip makers, they just need more diversification. I mean, if you look at who their customers are, they are so concentrated in the big U.S. tech names. NVIDIA has this problem. I think 20% of its revenue comes from Meta. So maybe you kind of skirt around some of these trade restrictions just to kind of help the diversification of the revenue so you're not caught out if Meta one day turns around and says, we're going to curb some of our AI spend.
That's exactly right. When these export controls came out from the Commerce Department, they're very narrow. So it's certain chips that these chip makers cannot sell to China. So what Broadcom is doing is, okay, if these are the parameters and the red lines, I'm going to build around that to make sure I can still supply the likes of ByteDance and potentially other companies in China. It reminds me of what a lot of people say about sanctions. Sanctions don't necessarily work, they just create new markets. Well, these export controls, they're working for some, but they're also creating new markets.
And so then the issue just becomes stability of some of these policies to make sure that the new markets can consistently move forward. Meanwhile, investors are looking ahead to a busy week, including a lot of Fed speak, as well as earnings from FedEx, Micron, and Nike. We'll also get data including consumer confidence, new home sales, another GDP reading, and that key PCE deflator that the Fed looks at so carefully. Joining us now, Bloomberg's Michael McKee. Mike, what are you most tuned into this week?
Well, there is more Fed speak, but it's not really going to be decisive at this point because we're waiting for data that would make a difference to them. We get that on Friday. So the PCE index for inflation is going to be the highlight of the week. The problem is we already kind of know what it's going to be because after you look at CPI and PPI, you can plug in the numbers and economists generally get that one pretty much on the screws. But if we get that, that's just more evidence that we move forward. I don't think the bond market moves a whole lot on it because this is basically priced in. I don't think that any of the Fed speakers are really going to move the needle at all this week. They didn't last week. We are just kind of in a holding pattern right now. It will be interesting, as you were talking about with Emery, to see what happens with the auctions because we've had mixed results. We had a couple of tails, and then all of a sudden the last two auctions stopped through, and there was more demand than anticipated. People are still buying U.S. paper. And that's kind of the question about all this is what's anybody in the bond market, what's going to make them care about something?
Maybe it's their summer holidays when they want to go away and don't want to be participating in this market.
That's the bad part about PCE on Friday. It delays your departure for the half.
Well, the good news is, as you say, we already know likely what it will be. So what are we expecting?
Well, we're expecting it to go down on a month-over-month basis, the headline to be unchanged and the core to go down 0.1%, which will push the headline number down to 2.7 and the core to 2.6. And you're getting closer and closer to the Fed's target of 2%. And if you just sort of extrapolate it out, you could see them easily cutting rates by the end of the year. Then the question is just how much do we move between now and then? Does it bring September back into play?
Michael McKee, stay close. Thank you so much for that. We'll be talking throughout the week right now just to get a sense of how to frame the week ahead and the path of rates going forward. Joining us, Stephanie Roth of Wolfe Research, Morgan Stanley's Vishy Tirupattur. Stephanie, I want to start with you. We've been talking about the auctions. We've been talking about concerns about higher rates. But you think that actually rates are expected to go somewhat lower over the next couple of weeks. Why?
Yeah, so we're looking for the 10-year rate to fall towards 4%, and then it could trend again higher when we start talking about the election and concerns around the deficits. But in the next couple of weeks, we could start to see just a continuation of the softer economic momentum. We've seen that in the past couple of prints, and that has brought 10-year rates back down to 4.26, which is certainly lower than many folks were expecting. Many folks were expecting rates to get to 5% before they come back down. But we've just seen that softening in economic momentum, partially because there is actually a genuine deceleration in the economy. Also, seasonals tend to put downward pressure on both inflation and growth in the summer months, and we expect that to be the case in the next couple of prints, which will bring certainly growth expectations back down a little bit. And then inflation should continue to miss. So, yeah, core PCE should come in something around 0.15% in the next print. We expect that for the next couple prints, which should allow the Fed to be able to cut in September.
And then after that, there could be something of a sell-off, a slight one at that, but still some modulation there from there. Vishy, what about you? Do you agree with that basically the data is cooperating with the bond market, cooperating with the auction schedule to allow yields to continue their decline?
I think the broad contours of what we expected are very much in line with Stephanie on there. I think the economy is clearly showing signs of deceleration, which we had expected. And it's deceleration, but not falling off the cliff. And we also, as Mike talked about, we expect core PCE will not be a big surprise on Friday, and we expect to see month over month 10 basis points in the core PCE numbers. All of that pointing to a deceleration in growth, a deceleration in the pace of inflation, setting the stage for a September cut.
So how much confidence in you have, Vishy? It sounds like a lot, but just gut check me here if it's true that we've seen the peak in yields.
I think in the near term, I think we have fairly confident on the trajectory of the path of inflation over the next, call it, rest of this year, the next 3 to 6 months. We have a pretty high degree of confidence that inflation will continue to decelerate, and we probably have seen the spikes in rates. I mean, the slight difference of view from the other speaker is that we think that we've been in a fairly in a range that we are really at the tight end of the range. So tactically, at this point, we are neutral, pending how the debate and the fallout from the debate will turn out. So, but over a longer time frame, our expectation is that rates will be lower. Our 10-year expectation is that the 10-year Treasury by second quarter of next year, we expect to see to 3.75.
Well, disagreements is what makes a market, luckily. Stephanie, first of all, I have to give you immense credit for this wonderful pun, now OER never, which is excellent. So you actually expect some of the OER to come down. Finally, we've been waiting for this forever. The lag that feels like it's never showed up. So you think that will finally show up in June? Why?
Yes, the June print is the time we're actually expecting it. We haven't been calling it for any particular month until this one. So this isn't necessarily a boy who cried wolf situation. So the reasons for this is twofold. One, the seasonals go the other way, very much so in the first half, and then June it flips. So we should have seasonal downward pressure on OER by a number of basis points. And then on top of that, there was a funky surge in the New York region, which contributed about 12 basis points to overall OER, which is about 10 basis points more than normal. So that should also put downward pressure because that's likely to go in reverse. BLS had put out some comments that it was driven by some noise within the region.
So we're talking about the next couple of weeks, the next couple of months, because that's all that we can talk about. Beyond that, it starts to get very difficult to really have any visibility. And it raises this question, like what we were talking about earlier with Seema Shah principle, that if you do get a Fed rate cut, that could potentially reignite inflation, particularly in the housing market. Stephanie, I want to get your thought on that first. Do you believe that based on how much pent-up demand there is and the likelihood of any increase in affordability will unleash a flood of interest?
Yeah, I mean, this time there's an argument to be made that it could actually be disinflationary. That's not necessarily our call. Our base case is that it'll probably be more neutral for housing prices generally than many expect. The reason is because all of a sudden you're going to unleash a lot of supply. So yeah, the demand is still there, but now you're going to get a lot of supply of existing sales because rates are coming down, and now it's a little bit more attractive than certainly it was when mortgage rates were above 7%. So you actually might get a more normalization in the supply-demand imbalance that could actually keep prices somewhat stable.
I mean, this is an argument that we've heard, right? Which is it disinflationary, inflationary, and everyone seems to disagree. And Vishy, I guess that this is a reason why it's hard to even gauge what's the bigger risk right now. Is it a potential reinflation if the Fed cuts, or is it a potential hard landing recession? I don't have a clear answer. And frankly, it seems like every investor who's come on this show has a completely different take on this. So where do you stand on this? I mean, which is the bigger, more compelling risk?
I think there is a whole host of uncertainties ahead of us. So we have a pretty clear path for the next 6 months or so that the shelter inflation that Stephanie was talking about will continue to decelerate. We get to the same answer as Stephanie does, perhaps in a different approach. We look at all the leading indicators in the rent index, the Cleveland Fed's rent index, and there is a clear lag, and that will begin to hit for the next few months. So, I think a lot really depends on what happens after. I don't think a Fed cutting in September will unleash enormous amount of supply into the market. We expect to do some supply. So we think that the pace of home price appreciation will slow from about 7% where we are now to end of the year. Our base case is about 2%. It is still positive, home price appreciation, but that pace will slow. But we should not forget that there is a huge range of uncertainty of outcomes of elections and a larger range of uncertainty of the outcomes of the elections. So all of that is very much front and center. So I think there's a lot of noise, and it's tough to decipher signal from noise. But what we do clearly see is over the next 3 to 6 months, this inflation is clearly on a decelerating mode.
And we're going to hear a lot of political noise this week, especially when you have this debate on Thursday. Stephanie, you write in your note, the first year of a Biden versus Trump administration may look more similar than many expect. Why?
So 2 things. People are worried about Trump cutting off immigration, and he will very likely cut off immigration flows, especially humanitarian parole, which is adding about 75,000 per month. The thing is, the labor market might be in much better balance by the time we get to the beginning of next year, that we don't actually need all of those people. That might risk putting upward pressure on the unemployment rate. So it might not actually be as inflationary as many folks expect. And then the second is, of course, on tariffs. And our base case is that the tariffs wouldn't go into effect until late 2025, maybe early 2026. So the inflationary forces of the difference in administrations might actually not pan out next year. Come 2026, of course, if we get tariffs, that would be a dramatic game changer between administrations and for sure. But for the first year, it's actually likely the economy might look fairly similar under both administrations.
The economy might look similar, but the rhetoric will certainly look different. Vishy, how are you looking at the election and how the impact could be for markets? Stephanie brings up 2 good points, immigration and tariffs, and what happens with those we might not actually see till 2026.
So we may not really know what how to think about elections much after that. What I would like to think about really is what are the products within, especially in the fixed income space, that will perform in either case. That puts us in the range of spread products broadly. So by spread products, I mean public credit, private credit, securitized credit, mortgage-backed securities. We see, as long as you take out that the next move by the Fed is not a hike, as long as we are clear about that, in the timing of the arrival of timing of cuts, how many cuts we'll get when they arrive, and the future course of the various policy options probably matter a little bit less to the spread product universe. So that's where we think that the best opportunity lies.
So just real quick, Vishy, what do you think will be the low that we'll see in the next 6 months for the 10-year?
I think we'll get to close to 4%.
So you guys both are on the same page, about 4%. All right, Stephanie Roth of Wolfe Research, Morgan Stanley's Vishy Tirupattur, thank you both so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Haquez. Yahaira.
Hi, Lisa. President Joe Biden taking on Donald Trump over the topic of abortion in a video released this morning, as today marks 2 years since the Supreme Court overturned Roe v. Wade.
Decades of progress shattered just because the last guy got 4 years in the White House. We know what will happen if he gets another 4. For MAGA Republicans, Roe is just the beginning. They're going to try to ban the right to choose nationwide.
Trump has said he believes laws over abortion should be left to the states to decide. The topic is almost certain to come up at the first presidential debate on Thursday. A hack disrupting thousands of car dealerships in North America is in the process of being resolved. Software provider CDK Global giving the update after auto retailers have faced days of disruptions. CDK is one of only a few providers of the technology used to track auto sales and services. Bloomberg reported on Friday that hackers were demanding tens of millions of dollars in payments. And Meta has held talks with Apple about integrating its generative AI model into Apple Intelligence, according to people familiar. The Wall Street Journal reporting that Meta and other companies developing generative AI are hoping to take advantage of Apple's massive distribution through its iPhones. When Apple Intelligence was unveiled earlier this month at the company's Worldwide Developers Conference, OpenAI's ChatGPT was announced as the company's first partner. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. The conversation here continuing very much so about particularly the housing market, just the idea of which is it? And I think that, Emery, you raised a great question. So which is it? Is it disinflationary? Is it inflationary? Is it going to be something where housing prices are going to finally go down for some people?
I think it comes down to those people sitting on a 3% mortgage rate that have been wanting to get in. Do they see a cut and they think now's the time to move and trying to upgrade? And how many of them are there that come in and release some supply?
Yeah, well, and also what's pricing like, right? I mean, if prices are the same as where they are, it's not as if affordability is getting any better. Up next, setting you up for the day ahead, you are watching Bloomberg Surveillance. About 38 minutes to the start of the trading down, counting you down to the opening bell. Here is your trading diary for the week ahead. San Francisco Fed President Mary Daly speaking at 2 p.m. Eastern. Tuesday, we'll get consumer confidence data, plus more Fed speak from Bowman and Cook. Wednesday, new home sales. Maybe we can figure out more about the housing market then. Thursday, durable goods, plus another round of jobless claims. And on Friday, the PCE deflator and our favorite indicator, University of Michigan consumer sentiment. Meanwhile, you do have the first U.S. presidential debate on Thursday. Voting in France this weekend. And the question isn't just what this means politically, but also what it means for markets.
The stakes here, I think, are very high, not only politically, which is obvious, but I think also for markets. You know, you all talked about, sadly, it's politics, but, you know, politics and U.S. political stability, you know, is an underpinning of the market that's been taken for granted so long that most investors don't even think about it. That's starting to be tested now, not just in the United States, but the UK, France, and beyond.
That's the reason why, as much as I didn't really want to start the show on politics, Emery, like that really is one of the most important aspects of this week, given especially what we saw in the French market.
Paul Donovan this morning from UBS. Politics, sadly, in focus. Sorry, Lisa. This week has a lot of politics in it, and markets, he says, are rarely that good at pricing political risk. The U.S. presidential debate may make investors pay attention, and because it's brought up in the calendar space so much earlier than we ever expect, markets need to start paying attention to it a lot more now than they usually would historically.
And just to be clear, it's not that I don't like politics. It's that you can't really get an edge or say something that really is going to be insightful in a way that can be predictive from a market perspective about politics at such an unpredictable time. And that's the reason why there is a sort of feeling in markets watching it carefully, but you don't really know what to do with it. I mean, to me, Danny, that's one reason why I find it fascinating that so many people have just hid out almost in big tech, saying this is sort of agnostic on the political cycle and on the economic cycle.
We're just speaking with Venu about where you find safety. I mean, he's like, look, consumer staples, they're not a safety trade anymore. The consumer is squeezed. So if you're worried about the economics, you're worried about the politics, you're worried about Europe, because that's a mess, the only place I have to go is big tech. That's why I'm really interested to see whether this week the weakness lasts or not. I know Nvidia's down again this morning, some 2%. Small caps are doing better. What happens if the big tech trade is taken out? Where do I go? I am not certain that I can go to my small caps, I can go to the economically sensitive sectors and get any sort of juice when we just don't know where this economy is headed.
Which is a reason why heading into Friday is going to be so interesting. And the idea of PCE deflator paired with University of Michigan sentiment coming at kind of a crucial point of view, especially with all of the politics.
Absolutely, because inflation and the economy continue to rank number one, not just on this side of the pond, but also when you look at some of the polling in France and potentially the reason why Marine Le Pen Pen's party may do well is because people in France trust the right wing a little bit more now when it comes to the economy. But Lisa, I was really struck by the Torsten Slok note you brought up. This fact that inflation expectations are becoming unanchored. And we are seeing this diversion depending on where you sit on the socioeconomic scale.
That, to me, again, inflation expectations becoming unmoored among people with less income who are actually seeing it that much more in cold relief in the grocery store, in auto insurance, and other expenses. Coming up tomorrow, we've got Sarah Hunt of Alpine Saxon Woods, Morgan Stanley's Mike Wilson, PGIM's Greg Peters, and Nuveen's Sarah Malik. From New York, this is Bloomberg Surveillance.